All right, everything looking good. Should be live. You can let me know in the chat. Everything's coming through loud and clear. In the meantime, let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market outlook, look ahead, market look. It is 8 p.m. Eastern Standard Time on 7/24/2022. And of course, as always, before we get started, I'd like to remind you none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and, of course, trade responsibly. Appreciate it. What's going on with you guys? New pathway in the chat. Got caught with their pants down. Honkiness says pound and clear. We'll do it live. Sotos loud and clear. Honkiness. Yeah, I knew what you meant. All right, CW. Sounding great. Great. Let's do it. All right. So obviously this is a big week. Over the weekend, we had a little bit of price action on crypto. For the most part, just came right back down to where futures closed on Friday. So essentially just right back at that same spot. There was a slight gap up of like $200. And now here we've come straight back down and closed it. So where we go from here, obviously, we will see. This is obviously a big week with the Fed meeting. And then the announcement of the hike. Still expecting 75 basis points. But there's a respectable, markets at least, it's given probability that there's, a respectable chance of 100 basis points. I don't think it's likely to happen. But, the market was pricing it in last I checked at like 30% or something like that. So definitely respectable odds. But I don't think it's likely. And if we do get 100 basis points, I'm going to tell you right now, I think that's extremely bad compared to if we just get 75. The difference being it's not that big of a difference, the 25 basis points, like in the grand scheme of things. But in one scenario, at least the rate hikes aren't like speeding up or becoming more larger. So the last rate hikes have been 25, 50, 75. So if we get 100, then that means we're still accelerating. We're getting bigger and bigger rate hikes each time. So that's bad. If we get 75, at least there's an argument that we're leveling off and that then the next step could potentially be, less rate hikes into the future. So even if we still get them the same frequency, if we get a 50 this time, then there's a possibility the next rate hike's only 25. And then, maybe a possibility after that, we don't even get a rate hike at the next meeting. But again, we have to at least see the trend, which right now is rate hikes, hawkish Fed, bullish rate hikes. We have to see that trend at least level off before it can go down. I think it's much less likely we suddenly go from 75 to 50 or 75 to 25. I think there's a way better chance that we go from 75 to 75 to 50. We basically like start kind of cooling off. So we will see. Obviously that's just my opinion. We're going to find out in a couple of days. What does that mean for the markets though? Well, the market is pricing in 75. So assuming that everything's priced in and the market is completely efficient, we shouldn't have to worry about the event. That being said, the last two rate hikes that we got, the market basically, as soon as we got the rate hike, the market ran up slightly for a few hours or a day or so, and then we sold off pretty heavily. So we'll see what happens. And the Fed even leaked out ahead of time that they were going to do 75 instead of 50. So it wasn't even like a surprise. So that being said, I would expect probably similar behavior. Now, the market has ran up in anticipation of all of this after getting record, CPI prints and whatnot. The data has overall, been pretty bad. And we know right now, of the two public mandates of the Federal Reserve, those mandates are, lots and lots of employment, which we have. We have record high employment and price stability, which we don't have. We have, record high inflation. So they've made it very clear that the mandate is now strictly inflation. And they've made it very clear that they know what has to happen in order for inflation to come down. Rates have to go up. Money has to become more expensive. People have to lose their jobs. They have to destroy wealth in the stock market and the housing market. Pretty much anywhere. They have to curb speculation. And that's exactly what they're doing. And they haven't given us any sign that they're going to stop doing that or even slow down at doing that. We know they're way behind to act. So, I'm going to assume that they're going to continue to act way later than they should. And, a lot of people are arguing now, obviously peak inflation. Same people have been saying it every single print we've gotten, and we still haven't peaked. We see no signs of peaking. So it's the same, obviously I'm all about the trend. You guys know that. So the trend right now is inflation is accelerating. The trend right now is the Fed is hiking at an accelerating pace, larger and larger rate hikes each time. So I'm expecting larger rate hikes and larger CPI prints and, just in general, these trends to continue until we see signs of them not continuing, whether that's, a couple data points that confirm we have peaked and we're rolling over. Even then, I'll be skeptical that we don't see some creep back in other places. We've talked about the whack-a-mole kind of scenario where you kind of whack the inflation in goods and then it pops up in services, and then you whack the inflation in services and then it pops up in energy, and then you go to whack the inflation in energy and it pops up somewhere else, and then the whole time you got the housing market continues to inflate, so then you whack that. And again, we just see this kind of like shift. So it's tough to get rid of inflation. There's a reason, that they have that old saying, don't let the inflation genie out of the bottle because you can't get him back in. And then instead the Fed basically shifted because Powell had been waiting for his inflation blowjob, for the last 5, 6, 10, 20 years, and he finally gets it. So now he's sitting back, relaxing, enjoying himself. And now, it got a little bit out of control. And now he's like, oh no, this is terrible. I wish this would stop. And you're like, oh, is this guy really sincere? Is the Federal Reserve actually sincere? Do they want to stop inflation? Or is this actually what they've been trying to get for years, and now they're taking advantage of it? They're sitting back. They're enjoying it. That's exactly what's happening right now. Now, the problem is, and this is a huge argument I constantly hear from people, is people always say, well, this isn't a USA problem. This has nothing to do with fiscal or monetary policy of the USA because it's worldwide, and there's a lot of other countries that are having worse inflation than the United States. To which I say that's correct. There is definitely factors outside of the USA that are causing inflation for sure. But let's keep in mind, in all these different games of Monopoly being played, each of these countries or, each of these like continents or sectors or however you want to divide up and, look at the statistics, keep in mind that in this one game of Monopoly, the one that we're playing inside the United States, that affects every other game of Monopoly, all the other countries or all the other portions of the globe, however you want to look at it, economies, that part of what the United States does, and this is such a huge, important point right now. I wish more people could understand what I'm about to say right now because it's so basic, but also I've never heard anybody break it down in so few words as I ramble on longer and longer. What I'm saying is part of the US's job or the world reserve currency's job is to export inflation to other countries. We need to export inflation. So by creating inflation in the United States through fiscal and monetary policy, we then export the inflation to everybody else. And what do I mean by exporting inflation? Well, we print a bunch of dollars, we create a bunch of currency, either digitally or physically or whatever, which we know we do that, obviously. We can look at the currency supply and see how it was inflated over the last couple of years, 30-something percent, 22%, total of 60-something percent in the last couple of years. We can look at all that. We know that. That's a fact. But where does that go? Where does that money go? Does it just get spent inside the United States and just everything in the United States gets more expensive? Well, some of it does, for sure. But we know for a fact that the U.S. runs trade deficits, which is part, again, of the world reserve currency. So we export, we send those dollars to other countries. Well, we don't just mail them to them on a pallet. We're not Obama. We're not just mailing, terrorists pallets of money. Okay? Or, sorry, I don't mean to get too political there. We don't literally just mail people money for nothing. We buy their goods. And therefore, we have inflated currency. We made a bunch of it. We don't have anything backing it. It's fiat money, obviously. We just made a bunch of it, and now we're going to go spend it on other people's shit. So we're going to basically, quote unquote, print money and then buy other people's stuff, and then they're going to have a bunch of that money, which is now going to be devalued because we keep making more money, which is just this just never-ending inflation cycle, quote unquote. The difference being, previously, we weren't seeing actual inflation in goods and services. We were only slowly just inflating away the value of the dollar or the value of the fiat currency, which is why when you look at that graph, there's that one graph you always see, and it's the dollar bill on a chart, and it's just going down and to the right, and you can only see like half the dollar bill, and it's like, oh, the dollar has lost 95% of its value since 1900. Sure, of course it has. Because, you know, that's the whole point, is to inflate away the debt essentially over time. It's like how the whole system is designed. So the idea that the United States, being the world reserve currency, causing a lot of this inflation around the world is a myth because everybody has inflation. That's bullshit. It's completely wrong, and it's factually wrong. Like, there's not even a question about it. So that being said, if you hear anybody saying, oh, there's inflation everywhere and it has nothing to do with the United States, stop blaming Biden, or stop blaming Trump, or stop blaming fiscal and monetary policy of the United States. No, they're 100% partially at fault. Listen to what I'm saying. They're 100% partially at fault. They're definitely at fault part of the way, 100%, without a doubt. So that being said, it's a common myth I hear coming around where people are just constantly saying this over and over again, and understand that, one, the Federal Reserve in the United States government and pretty much every other government around the world, especially if they're running trade deficits or have massive amounts of debt, especially in relative to their GDP, which they would not normally be able to pay down, especially at like a historically average interest rate, they want inflation. They want inflation. So now that they caused inflation, finally, they, caused too much inflation. Sorry about that. They're mopping it up, but they're taking their sweet ass time. And all of these, you know, it's obviously a web of factors, but the United States being world reserve currency is definitely one of the factors of that. Now, obviously, every central bank is responsible in some degree or another, but for sure, the United States Central Bank, the Federal Reserve, is more responsible than all the other central banks. All right, so let's take a look at what we expect. What have the trends been so far? What has been taking place? What has been going on, you know, leading up to these Fed meetings? Once we get these hikes, you know, the inflation, what do we know? We know for sure that until inflation comes down, we're not going to see the Fed pivot. And we know that until the Fed pivots, it's not good for valuations, for markets, for speculative assets, etc. So do we expect the Fed to pivot at this meeting? No, there's no way the Fed pivots because there's not enough new data that would make the Fed pivot. As a matter of fact, it's the opposite. There's more data that would make the Fed not pivot, aka the 9.1 CPI print in the United States. So that being said, even if we get bad jobs data, even if we get more unemployment, even if we get, you know, whatever other data in the meantime, none of that's going to change anything because we need probably like 2 months worth of data where like the CPI is coming down, or, you know, et cetera, where we're seeing like catastrophic job losses, you know, essentially multiple months of data before we see the Fed pivot. And before the Fed pivots, they need to slow down the rate hikes. And before they slow down the rate hikes, we need to see a peak in the acceleration. And we're still seeing acceleration. So 75 is the beginning of that, at least leveling out. 100 puts us right back to where we're at and is worst case scenario for me. So looking at the 10-year TNX, we talked about these levels. If you guys did your homework, like we talked about in the last stream, obviously for the group members, I posted up a bunch of the data we were talking about. Where was the Fed funds rate back in 2018 relative to where it is now? And then looking at the 210 spread and everything, and then looking at the spread between the Fed funds rate and current rate hikes. And essentially what it comes down to, if you go and you do your homework, or if you're lazy, you just want the cliff notes right now, what it comes down to is basically if we get anything more than 75 basis point hike anytime into the future, we'll have a technical breakout of the Fed funds rate, putting in a higher high relative to the 2018 high before Trump put Jay Powell in a headlock, gave him a wedgie, teabagged him, and then made him cut rates again. So that being said, a technical breakout is undeniable once we see that in the Fed funds rate. As where with the 210s, you can kind of say, oh, it's kind of a breakout, it's almost a breakout. No, it's undeniable. And that changes, potentially causes a pivot in the bond market. So what do we expect from the 10-year? Well, obviously we didn't take out that low. That was a key area to watch. We know that if we basically go much lower than this, once we get that 75 basis point hike, 2.25 is essentially where the Fed funds rate will be at. And there's typically, a pretty nice gap between the Fed funds rate and the 10-year, let alone, the 2 or whatever other metric we're looking at. So again, we would expect a potential for a breakdown for a lower low right here, but we wouldn't expect it to break down below the 200 exponential and simple. The trend is still very much to the upside. Let me turn off the drawing tools. But we are back testing the 21 right now on the weekly. But again, this is like the strongest trend at the very beginning of the trend when the 200 exponential crosses over the 200 simple. But we have a hard sell. We left the bullish control zone. We have all red histograms. We're retesting the 21. So potentially what could happen right here is potentially, now I'm still bullish on this longer term, but potentially we could back test the 200 exponential and simple. But again, that doesn't really line up. Now, it's always a possibility once we confirm into a bull market that we back test and then we go higher, which is what I would assume will happen. But then when we look at those other metrics and we say, well, how low can we drop in relation to the Fed funds rate? When is the Fed going to pivot? All that stuff. We go through that whole mental gymnastics and we play out that, choose your own adventure. And we say, what are the possibilities? How deep could this retracement come down to? And essentially what this chart tells us on the weekly is that we basically can't go much lower here. I mean, we could get a little bit of a push down, but we're not going to get anywhere near, these moving averages right now are at 1.75 and 1.86. So it's damn near impossible for us to get down to those levels. And it's definitely impossible if the Fed doesn't pivot, because we're not going to see, if the Fed goes 75 basis points at this meeting, which we expect obviously to happen, that's going to put the official Fed funds rate at, it's like 2.33. So if it's 2.33, we know obviously it doesn't make any sense for the overnight rate, to be that so far inverted that it's below the 10. It's one thing to say the 3-month. It's another thing to have the 210 inverted or the, 530 or whatever other metric. But it's pretty realistic to think that we're not going to see an inversion between the Fed funds rate, which is the overnight rate, compared to, the 10-year. So even if we get down to that same level, we're talking about 2.33. So that puts us somewhere around, where my pointer's at right now, somewhere around here. So I could see that happening. It's possible that we see that happen. But what would be the catalyst for that happening? It would have to be that the market thinks the Fed is pivoting, basically. So, maybe we get one more nasty candle right here. But when is that going to happen? In the next 2 days? It just doesn't seem likely. It looks to me like we're probably going to bottom out somewhere around this area and then go higher from here. Now, momentum, says further downside. We're starting to lose the trend. Obviously, still very, very bullish, but typically we would expect a back test. I just don't see how we get that deep back test with everything going on right now. Now, it doesn't mean it's not possible. I just don't see, a way that happens. And then here, if we look at our monthly chart, obviously in the bullish control zone, all green histograms, just flipped the slope line blue. Very, very bullish setup. The 8 and 21 are bullishly crossed to the upside. We just crossed above the 200 exponential and simple. The 200 exponential is flipped bullish. The 200 simple is basically flat. We're back testing the 200 simple now. 200 exponential. If we back test the 200 simple, that's 2.62, which again, I could see that. It's still over, it's still reasonable. Again, we could get back down to 2.45, somewhere around there. It's reasonable to think we get a little bit more of a push down right here. But after that, I just don't see any more room for us to go to the downside. I don't see much room for like a deep retrace back test on the weekly. It seems much more likely we're going to get a shallow back test. This is going to flip bullish, and then we're going to be in a full-on bull trend confirmed on the weekly. Now, one thing we can look for to try to time it, and obviously technical analysis, the hardest thing to do is timing, which is why I'm not a huge fan of options, because you can be right, but your timing can be off, and then you lose. And then you'll be right afterwards every time. But that being said, we have the histogram pulling back to the slope line. And oftentimes, whether we're going to see bullish continuation or, just break down and roll over the trend, we oftentimes will see a bounce around that level. So maybe in the next week or two, these start to converge and we see that bounce from around that level. And that's the support we find. And then we actually just take back off to the upside. Now, we don't know. That's just hypothetically speaking. But it's hard for me right now to using technicals and fundamentals to make a case for the 10-year going much lower. And I mean, if you have one, I'd love to hear it. It's just very difficult for me to think we're going to get down here for a deep retrace to backtest on the daily 200 exponential or simple, which is still bullish, the weekly 200 exponential and simple, which is still bullish, and now the monthly 200 exponential and simple, which is very bullish. We're already backtesting the 200 exponential. Maybe we get back to the 200 simple. But that's my case for yields and what's going on with the Fed, and obviously my reasoning behind it. So what does that tell us about TLT, 20-year actual treasuries? I mean, probably going to get rejected right here and then push back lower. I mean, if we're expecting the yield to go higher, obviously we're expecting treasuries to go lower. At resistance, we did gap up back into, the channel, back testing the descending channel. So now we're inside of the ascending channel that we've been in for like literally a decade. And then we're trying to back test the descending channel right here. So, I mean, if I'm wrong and rates go much lower, we'll be back inside the zone. And then we probably get the back test, which is what we were thinking was going to happen a while ago. But now, with only a couple grains of sand left, it doesn't seem nearly as likely. It seems like this is going to be an underperforming bullish move after a bear sell-off and then just a rejection and go lower. Now, I could be wrong, and that's completely fine. Also, we see a big knife stab up here on that gap up. I don't know. I have a feeling that this is going to play out exactly how I picture it playing out, and that everybody's going to be on the wrong side of this. But, I mean, we'll wait and see, though. That's the best part about the markets is, especially having a channel is, everything's out there. So we can go back and say, told you so. Or, oh, I was wrong. What didn't I see? How can I make sure this doesn't happen to me again next time? What was telling me lies that I know I should give a little less credit to in the future and eventually maybe should be cut out of my game altogether? We'll see. So here's the VIX. We talked about this scenario happening where we basically get a daily lower low on the VIX and what that would mean for potentially printing bearish divergence. So here we have a lower low on the price action, but we have a higher low on the actual drive right here. And then between these drives, they're basically at the same point. So let's just say, hypothetically, what was going to happen right now. Let's just say, hypothetically, this is going to reverse now on Monday. And we're just going to start going back up. And we're just going to test the top of the range again. We're just going to basically just continue trading inside the range, just like we've been doing, which is my base case. That's what I think is going to happen. Now, when we look at this price action here, we're at 22.9. The previous little mini swing inside of our macro or inside of our like larger move down, we have these two swings, the current price and the previous price here at 24.64. And then from that level, we actually have a previous low right here as well at 23.76. So what we're looking for is the relative. So this one is the lowest. It's lower than that one. And then this one relative skipping that one. This one relative to this one is also lower. And then when we go over here and look at the indicator oscillators, we see we have the lowest low on that first drive down. And then we have basically two of the same low, which are both higher than this one. So that's bearish divergence between these 2 points, potentially, if we pivot and start going up right now. I'm sorry, bullish divergence. That would be bullish divergence between these points. And then between this point and this point, again, it's bullish divergence. Because here we have a lower low. And then between these two, we have the same low. And between these two, we have a higher low on price action relative to the indicator. And then again, if we just go over and look at this, we're right here now. We're basically at that same low again. Here we've went lower, so there's no bullish divergence between those two. But again, if this just pivoted now, which we don't know if it is, it might just go down lower, invalidate any potential bearish divergence or bullish divergence, and that's it. We just break down from that channel. Volatility goes down to 15. Markets soar. Everybody's just eating cake and living the good life, and markets are fine. We're not in a recession. The economy's great. Who cares about energy prices? Who cares about food prices? Land war in Europe, not even a big deal. Are you kidding me right now? Who cares about nuclear, problems? Everything's fine, right? So that could happen. That's a possibility. It's not my base case, but it could happen. But regardless, we could invalidate this bullish divergence. But for now, let's just assume that I'm going to be right and we're going to bounce this same kind of zone that we've been kind of bouncing. Because obviously the way this is drawn, we've been outside of it plenty of times. But if we just kind of look at it like a little more like this, and we say, okay, sure, that bottom of the channel, that's our longer time frame. Like, oh, this is the bottom of the channel. But it's not like this is a line in the sand, and if you go past this bottom of the channel, it's over. No. That's what the blue line is. So the blue line is saying like, hey, we've never broken down from the channel that much before. So we'll look at that level. We'll see maybe if we hit the heart line, maybe if we backtest the descending channel, maybe if we hit the blue line right here, we'll start saying, okay, maybe, get through that. Maybe we're wrong. But for now, it looks to me like we're just bouncing the bottom of the range. So we'll see what happens. We know that if this volatility starts to pick up, that means price action is going down. People are buying puts. They're trying to cover their ass because they're expecting downside. Now, is that going to start first thing tomorrow? I mean, we had a fairly weak close on the stock market, but obviously the VIX didn't reflect that too poorly. But stock market could easily run another couple days, could run off the news and then sell off later. It could start selling off right away. It could just run forever and everything's just fine, and that's it. We don't know. We'll see what happens though. So looking at oil. Okay, we've been discussing this oil chart. It has played out absolutely beautifully. We're at the bottom of the range. We're at the 200 exponential. We're at the 200 simple. We're at the bottom of the channel. We're in the target area. We had a pretty strong rejection of lower prices here, and then we closed a lower candle, which is not good. And then on top of that, this lower candle right here is basically, at or the lowest candle that we've had so far. So not good. So we're kind of getting mixed messages because we're at support. If this support was going to hold the 200 exponential or simple, we would expect a strong rejection, which we got, but then we got no follow through and then we immediately tested it again. So this looks more like, to me, gravity is playing out. Now, typically what I would expect, if I was just looking at this and you said, hey, without going like too deep into it, without getting too crazy, without even telling me what chart we're looking at, and you just said, what's the likely way that this chart looks if you just look like 2, 3, 4 weeks into the future, I would say, okay, we're probably going to bounce this area, come back up here again, come back down and put in another lower high, retest the bottom, chop around a little bit, and then we're probably just going to shoot back up to the halfway range, chop around, come back up here, and then eventually put in a lower high and then come back down. And I would just assume we're going to continue trading around inside the range, because anytime we're in a range, I just assume we'll be in that range, and then eventually when it breaks, then we can reevaluate. But more often than not, support acts as support, resistance acts as resistance. So if we buy support and we sell resistance, we just get to play the range and we don't have to wait for the big breakout, which by the time, if you wait, it's almost always too late to get in on it anyway. So anyway, you can have whatever strategy you want. That's just my strategy. So that's what I think is going to happen into the future. Now, there's another situation, and the reason I say that is because distribution takes time. And this looks to me like distribution. Matter of fact, depending on how this distribution looks, I could arguably say, well, there's actually a really high probability that it actually right here, we retest the top of the range, we come back down right here, and then we actually bounce around a little more, and then we break out, and then we actually go higher, and then we roll over, and we get, damn it, I hate this tool. Hang on one second. We actually get like, Wyckoff type 2 distribution, where we actually poke up here, put in a new high. It looks like a confirmed breakout. That's obviously like deviating from the initial path that we talked about. So we'll switch that blue. And then, we get up there, we take out everybody's stops for shorts because we put in a higher high. Everybody's convinced we're going to new all-time highs, get super bullish on oil. And then what actually happens? Well, we can't quite hold this level. We break back down. We come back down to the bottom range. We bounce around. And then eventually we get the break of the channel. Now, again, neither of those three situations have to happen. We could literally just break down right now, and that's the end of it. And then we go from there, and I wouldn't be surprised. We could also play out this exact situation perfectly, and I wouldn't be surprised. This is basically Wyckoff type 1 distribution, where we don't take out the high, type 2 where we do take out the high, and then regardless, this looks to me like distribution and we break down. And then again, you would expect to bounce off the 200 exponential or simple, but we're really not seeing that right now. So, we don't know what's going to happen with oil. Obviously, this is very speculative. None of this has to play out, or it could play out perfectly. But the fact of the matter is, we already have a roadmap for oil and what could happen right here. We know if we just break down straight from where we're at now, we retest this fib, we retest, basically come down to the measure move of the channel, et cetera, et cetera. We have this long-term trending, ascending, broadening wedge that we broke out of, and we would potentially be backtesting the bottom of it. We have a path forward from here, and then we can see how it plays out. That's the most important thing, because we don't know what the macro is going to look like, a couple months from now, let alone a couple years from now. We don't know what this oil chart's going to do. We don't even know for sure this is distribution. But now we at least know when certain things start playing out, and we can have triggers one way or the other, what's going to happen. But to me, this trade looks tired for now. It looks done. I don't see anything telling me that all of a sudden we're just going to start moving to the upside. And if we do, I'll be very, very skeptical of the move initially, especially if it starts looking like distribution, psych out or like a throw over type scenario. So on to the Dow Jones. So we talked about the close. Obviously we're pretty bearish or bullish. A couple weeks, especially last week, and then we had a fairly bearish close. We didn't bearishly engulf or anything like that. It wasn't terrible. We didn't break down from the 8 or 21 or anything. So it's really not bad when it's all said and done. The Dow Jones technically looks pretty good on top of the 236, so that's good. There's some ascending resistance. We obviously have the 200s above our head. We obviously have a situation with the VIX right now. So what's going to happen? Well, we're either going to get a push up here and a breakdown in the VIX, or we're going to get a breakdown here and a push up in the VIX. But basically, we're there. We're at the point where one way or another, the market's going to decide real quick. When we look at the weekly, we got a nice bounce up here. We closed bullish. Little rejection on top, but nothing serious. And we closed above the 236, above the 8. Now we essentially likely come up and retest the 21. A couple green histograms, potential for, a bull cross sometime in the near future. Markets actually look okay right now. They really do. They look like they're, obviously finding at least some temporary support off of the 200 exponential and simple. Now look at this chart relative though. What we have here, the 821 cross to the downside. We backtest the 200 exponential and simple. We bounce the 200 exponential. We come back up. We're still putting in a lower high for right now. So we don't want to get too bullish right now. But when we go to the daily, does that remind us of what the weekly looked like when we first came down to it? Does it look like that's going to happen to us again here? We'll have to wait and see. We're basically at a big inflection point. Looking at the SPY, looks very much the same. The relative to the Fibonacci level, the 236 right here, much more important in my opinion, as the Dow Jones was up above, kind of in nowhere like land a little bit. Here we got rejected directly off the 236. So on the previous run up, we were slightly more bullish on the S&P, and the Dow kind of underperformed, and then obviously the Nasdaq and the Russell performed very, very poorly. Now we're seeing the S&P is kind of underperforming. And if other people were looking at this descending resistance, which I'm sure they are, it's pretty clear right here, you would expect a breakout, a backtest, and then continuation from here. We're not seeing any continuation yet. A little bit, but I would expect a strong continuation with the 821 cross and then a breakout of like a very clear resistance. We're not seeing that. What does that mean? Well, maybe it just hasn't happened yet. But when I look at the knife and I see it at extremely high levels, I see a sell, a space, a buy, a space. Maybe this is about to cross back down. We're about to get another sell. I don't know. We'll see what happens here. It definitely moved away pretty aggressively on the last couple moves, building up some momentum here. So we don't want to get overly bearish right now because the charts are starting to tell us, hey, like while we're expecting a reversal of the bull trend and continuation to the downside, we're definitely at or close to the levels where we could see a powerful move back up here to retest the 200 exponential and simple. And maybe, just maybe, yields are going to come down, bonds are going to go up, the Fed's going to pivot, stock market's going to roar, risk back on, and everything's gravy. Maybe. Anything's possible, right? So Nasdaq Composite, again, we're still putting in a lower low right here, but overall we have a higher lows and higher highs, essentially in like a little channel right here, trying to backtest the 200 exponential and simple. Again, the knife is pretty aggressively high right now. And then if we just go over to our weekly and look at that close, what did we do? We bounced the 200 exponential, backtest, bounced the 200 simple, lower low, backtest, finally took out that previous low, and then we shot up basically to retest the 21. Hard buy signal on the weekly, bunch of green histograms. This is basically, if I was, let's just say conspiracy theory, full on conspiracy theory. Let's say I was a market maker, okay, a whale. And let's just say that I knew that a lot of other people do technical analysis as well. And I was trying to trick those people by painting the tape, so to speak, or moving the markets in a way that would be beneficial to me, sort of manipulating how you feel or what you think is going to happen. By, say, having a couple week rally, sustain, put in some higher highs and higher lows, put in some hard buy signals, some green histograms, get y'all excited on shorter time frames. That's what I would do. That's what I would do to get people bullish, to get people to basically buy when I was planning on selling or have been selling. We'll see though. You know, I'm not really a conspiracy theorist. Matter of fact, I kind of go the other way about it. But we'll see what happens. That's what I would do. So the Russell obviously been pretty poor lately. Nice little performance in the last couple of days. Again, we see a very aggressive knife stab up here on the daily. Decent momentum still as well. A reversion of the cross to the downside. Weekly looks like a back test rejection so far of the 200 exponential. We closed in between the 200 exponential and 200 simple. We've been in a bull trend. The 200 exponential is still on top. Technically on the weekly time frame, we should be bullish on the Russell. Technically more like neutral on the Russell. But we have the 821 still in a downtrend. We're back on top of the 8. So at this point in time, the safe thing to do, the responsible thing to do is to say, hey, if I was going to get bullish on the Russell, because technically we're in a bull trend based on the 200 exponential and simple, technically we're neutral because we're between the two and one's red and one's still blue. I would just wait until the 821 are back to the upside or we're at least above them. So if we get back above the 21, we get back above the 200 exponential. So then we're above both the 200s, we're above the 8, we're above the 21. And if we just stay at that level long enough, the 200s cross bullish again, the 821 cross green again. And, you know, it's all butterflies and unicorns and pots of gold at the end of the rainbow. 1869 is the area to watch on the Russell. So I'm sure Elon will be watching that. 69, he's all about it. So 420 and 69. So that's the Russell. That's what I'm looking at. You know, again, we're sort of at that pivot point. We obviously have a fundamental pivot coming up with the Fed. You know, we have a lot of technical pivot points as far as the 200s, as far as support and back testing some of our, you know, Fibonacci's, moving averages, resistances, etc. So we'll see what happens. We're going to find out real soon, you know, if we're pivoting and going back to the downside, or if all of a sudden we're going to pivot out of this bear trend and potentially start bullish again. And either way is great. I would actually rather we pivot bullish. I mean, not for like the benefit of longevity of the financial system of the future, but for like the ease of just making money. It's much more easy to make money in a bull market, especially when everything's like full on bull-tarded. So on to our sectors. Obviously, nothing has changed with our sectors. We've been through this a million times. Of our 11 main sectors, currently, right now, we have a couple of sectors basically are neutral and every other sector is bearish. So of those neutral sectors, those are the ones we're paying attention to. We would expect money to flow into those sectors from, you know, essentially like funds where they don't have a choice about just sitting in cash. They have to be allocated 95 or whatever percent. So we would assume that they're going to allocate more into the winning sectors or the neutral / bullish sectors if everything else is bearish. Therefore, we know the concentration is likely to stay in energy, healthcare, et cetera, consumer staples. So we'll see those as we go through, obviously. But XLI for right now, industrial had a nice move back to the upside, but still very much bearish, well below the 200 exponential and simple. Could see a little more move to the upside. Still, again, looking bullish. Everything basically looks bullish right now in the markets. You know, if you didn't know the Fed meeting was coming up or it just wasn't a factor or there wasn't one coming up or whatever, you could start arguing like, hey, maybe there is a possibility we at least get a decent sustainable bounce on the weekly. Now, granted, we could still go much lower, put in lower lows, but at least we would be getting a sustainable bounce off the weekly 200s. Right now, it looks like they're, you know, again, I've said it a million times, but we're down to the last couple grains of sand in the hourglass. So it's hard for me to think like, hey, there's still a lot more upside potential. For me, it's like the risk reward right now for bullishness is basically gone. As a matter of fact, it's sort of like a front run between like intelligent market participants to be like, you know what, that was good. We had some nice moves. I'm going to just get out before everybody else does because I don't want to have to worry about, you know, a liquidity run or stop run or, you know, just waterfall, cascade to the downside, etc. So XLP, consumer staples, we are below the 200 exponential or simple. They're technically not confirmed into a bear trend. Again, this one is basically, you know, one of the neutral ones. Obviously, safety play. XLF has technically broken out of this descending wedge. Again, no movement yet. Nothing really going on here. Pretty aggressive knife each other previous time. That reflected in one of these tops. So we can see very clearly the knife had identified the tops either right at or right before it rolled over. So it seems likely we're about to roll over. Again, very bearish. XLRE, so real estate, again, still pretty damn bearish. Still waiting out to see what happens. Looks like we'll probably get the back test of the 236 if we don't run out of time, which it looks like we will. XLV healthcare, again, one of the neutral ones, technically like one blue, one not blue, in between. Well, price action technically is slightly lower now, but again, very clearly healthcare, one of those safety sectors. And what is it really? Well, if we're going to go into a recession or stagflation or whatever this bad, like worst case scenario that that's dark cloud looming, where do people want to be? They want to be in those same sectors: consumer staples, healthcare. Obviously energy's going good right now. Utilities. Those are the main areas. Now, normally I would say real estate as well, but the problem is with the real estate bubble and rates going up and everything, that may not reflect the same way that it has previously in the past. Because if you start taking all these extra factors and putting them in and saying, well, if we look at what it was like when we went into a recession this time, and then we factor in this, this, and this, then all of a sudden it's like, well, maybe real estate might not be the best place to be. Like 2008 type scenario, where we have like a real estate crisis versus a 2000 type scenario. The same way that the VIX, reflected differently in like 2000 and 2008. We didn't see a massive spike in the VIX the same way in 2008 as we did in 2000. So sometimes, and again, if you look at the DXY strength in 2000 compared to 2008, in one, we're putting in a macro top in 2000, and in 2008, we're putting in sort of just like a medium little top that's much, much lower. And it's like, well, wait a minute, the 2008 deal, that was global, that was a much bigger deal, etc. Well, that factored in, and then the dollar actually is affected differently. So there's always going to be like factors. So be careful when you hear people saying, well, this is just like 1970s and the 80s. This is just like the 1920s and the 30s. This is just, it's not like anything. Because if you take any one of those examples, there's some main big factor that was not the same back then. So if we continue on here, XLB, obviously, seeing quite a bit of weakness from materials. It has reclaimed the 236. Again, the posture on the daily, even though we're below the 200s on these, and they're obviously bearish, the posture on the daily is like, hey, we could actually see a little more continued upside here. And again, if it wasn't for the grains of sand counting down, I would probably be moderately to much more bullish on these markets. XLY, consumer discretionary, backtesting that previous high right here, could easily run up to the 236 if it has some more time, which maybe it does. Maybe it does that in the next 2 days. A massive move, for the stock market. But again, still very bearish. Here we see utilities, obviously playing off nicely, very neutral just here at the 200 exponential and simple, just completely neutral right now. Just, hey, whatever. We haven't made up our mind yet. We'll see what happens. So if everything else is losing money and you're just going sideways, you're winning because you're not a loser. So you're winning by default. Everyone else is getting eliminated with their losses and you're just doing nothing. So that's winning. If everybody else is losing and you're not, you're beating the pack, and that's what it's all about. You're not always going to be making ridiculous gains. Sometimes it's more about the preservation of capital. And obviously that's a big part of my strategy. XLC communication, the worst sector, obviously below the 2020 highs. Very, very weak. Down here between the 618 and the 0.5. Absolutely atrocious. And people are like, yeah, it's down horribly, so that's why we're going to buy it. It's because there's so much value right here. Or the market just knows that it's going to be a rough patch ahead. Because it's weird how people think. They say, well, the market's already priced in. And then you say, oh, okay. And then they say, well, I'm going to buy this one because it's already beat down so much. And I'm like, well, if it's already beat down that much, I thought everything was already priced in. And they were like, well, yeah, but it's overreaction to the downside. Throwing the baby out with the bathwater. And I'm like, well, it's one or the other. The market's either efficient and it's always right and everything's priced in, or it's not. And sometimes the market's wrong. And you guys know how I feel. The market's always right until it's wrong. There's a reason there's big swings and volatility on the markets because somebody was on the wrong side of a trade. So in my opinion, if you're going to say the market's always right and everything's priced in, well then communication's priced in. So it's fair value right now. So it was just really, really overvalued for a long time. And eventually the moving averages will catch up. Now where we're going to be at that point in time, where the fair value is, I mean, I don't know. But, if the market's that efficient, we're at a fair value. So buying the dip right now, just because it's beat down, doesn't seem like a good idea to me. I don't want to buy the horse with 3 legs. No, I'll buy the guy that's winning consistently. You're like, yeah, but the odds. And you're like, yeah, but the probabilities. Who cares? The odds can be phenomenal. If the probabilities are low, who gives a shit? I mean, if you tell me literally, hey, I'll pay you 100 to 1 odds if that horse wins. And I'm like, wow, that's a really good deal. What's the probability? And you're like, 1,000 to 1. I'm like, well, so you're going to pay me 100 to 1 if it wins, and it's 1,000 to 1 that it wins? That's a bad deal. But for some reason, people see that deal and say, well, that's a good deal. Look how cheap it is. And then they look at recent prices and they say, well, it was this price. So if we just get back to that price again, everybody does it. And in some situations, it's reasonable. But you have to assume in that situation that at some point in time, this company or stock or crypto or whatever it is, NFT, it's going to be worth more in the future. Somebody's going to want this worth more. So it's a company that's going to add more value or have more earnings or, trade at a higher multiple or whatever. If it's a crypto, it's because it's going to build up the network effect and eventually it's going to solve some problem or do something better and seamlessly. And that's great. Or the actual probability says that likely once something sells off, 75% or 90% from its all-time high, that actually the probability favors that it actually goes to zero or trends downward until it basically goes to zero. But, nobody ever talks about those things. So tech obviously looks very much just like, the NASDAQ, slightly more bullish, holding up moderately well, but still very much in a bear trend. And then going on to energy. Energy, obviously, by far the best sector. The only sector that is still above the 200 exponential and simple and still has blue slope line on both of them. So again, why I don't want to get bearish on oil and, energy right now is because of that concentration. Because when everything else is losing and there's one thing that's doing good, the likelihood of that thing doing good is so much better than everything else. Because people are going to pay attention to what's winning and gravitate or migrate or be drawn to that winner. I mean, the way I look at it is you got one of those bug zappers out in the wilderness. Everybody's trying to have a good time. You got the little bug zapper out there. And all these bugs are just coming from all over, just getting zapped. Bzz, 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 big juicy one. That's what, the winning sector is like. When everything else is terrible and everybody's losing consistently, definitely not making gains, they're drawn to energy. And that's why when we got the big spike and we were calling for the top and everything, and we were like, okay, look, everybody's on the same side of the trade right now. So maybe it goes a little higher, maybe it goes a little higher. But eventually somebody's going to take profits. And that's when we get the big cascade down. And that's how we're able to get out of the way, take profits, lock them in. So now I don't want to get bearish right now on energy because realistically, a lot of people are going to buy the dip. I think we're going to come back up here and put in another lower high. So that's what I'm preparing for. As people are going to say, well, I was over allocated in this, and this last quarter, last half, last year. And now energy's been doing well. Every other chart looks like crap. All the other sectors look terrible. So where should I go? Well, let me just go towards the only chart that looks decent. The only thing that's been winning. Let me go in heavier now. I was under allocated before. Now I'm going to be over allocated. So we'll see. And that may push us up to a new high. We don't know. But I don't want to get bearish on the one sector that's bullish right now. And, it's possible that it just rolls over and it just gets absolutely crushed. And you're like, oh my God, that's crazy. It just went down 35% in a single day. Seems much less likely after we got this big drop. And the chart is still technically bullish. Now we'll see what happens. What I would like to see for this to be bullish and actually, add to this position and get excited about it would be essentially just to continue to put in higher lows, higher highs, and then cross the 821 back to the upside. We should do that right around $72.50. We have a bunch of green histograms, hard buy signal. Aggressively, stochastics are trending to the upside, obviously running into a little resistance right here. But even if we are going to go lower, I would expect first to put in a lower high. Maybe even a higher high and then go lower. We'll see. But I'm looking for the internal retracement fib. Maybe the 618, Maybe the 786 lines up with the macro a little more, possibly shallow, and it only goes to a 0.5. I think that's less likely. So we'll see what happens. But if we get on top of, basically 72.50, let's say, I'm expecting a big move, 12%, something like that, is pretty good, and probably over just a couple days. And then we'll see what kind of happens when we get up to those levels. We'll see what the rest of the market looks like. We'll see what the fundamentals sound like, et cetera, et cetera. But that's what I'm paying attention to now on energy, and sort of my rationale why I think energy will hold up better, if not put in some gains still going into the future. Even though, short to medium term, I'm a little bit bullish on energy. Medium, I'm actually bearish on energy. And then long term, I'm extremely, extremely bullish on energy. But it would not surprise me if 6 months from now, we're at a new low. Not at all. That's actually my base case. So XTN transportation, obviously, we're seeing sort of that little breakout back test right here, which is normally pretty bullish. Again, a lot of like bullish setups for a potential move to the upside. Now, when I say bullish setup, it's a bearish move to the downside with a bullish retracement of the bearish move, typically followed by continuation of the bearish move to the downside. So we'll see how this plays out. But, we obviously have this trade set up here, another 10% or so to the upside. Just a back test before we go lower. Back test to 236, back test to 200 exponential, measure move breakout of the descending wedge, off of key support levels, the previous high from 2020 and 2018, et cetera, et cetera. Now, after that happens, I do expect, further downside. Still a very bearish chart. And then obviously we know energy, transportation, semiconductors, and the 210, yield curve inversion is basically, our signals, the four horsemen of the apocalypse, all flashing before 2000, all flashing before 2008, and now all flashing, before what's potentially coming, or has already started, I should say, in 2022. So XSD semiconductor ETF. So it looks like we're likely going to get that continued push back up. The back test of 236, back test of 200 exponential, possibly 200 simple, although seems less likely, and essentially just fill out what we were talking about for that potential head and shoulders, which obviously is a topping distribution pattern, and then the breakdown would take us to much lower prices. We'll see how low, and then obviously, we've already confirmed into the bear market on the daily. The weekly chart, semiconductor weekly and monthly chart, still very bullish. Nice bounce off the 200 exponential. So we'll see what happens here. If we get the rollover the right shoulder, we get the retest of the 200 simple, the 0.5, possibly, the 2020 highs, etc. That's still a ways down here. And that topping pattern would essentially tell us like, hey, we're going into another like macro slowing environment, which is not bad. It means, okay, hang on, maybe these semiconductor companies aren't going to be selling a ton more chips because they're backed up and, they're already at capacity and they're not going to have any new capacity coming online for like 2, 3, 5 years down the road. But in the meantime, we could see some of these companies investing, shoring up like onshore manufacturing, basically like bringing it back home for safety, security reasons, etc. Or whatever, whether it's for cars or missiles, probably better to have your own semiconductors, etc. So we'll see what happens as we go into like this sort of deglobalization or like nationalization. But nothing could change, in my opinion. There's nothing really that can change the semiconductor outlook in the next 2 years. Okay, because what could possibly happen that would be bullish? All of a sudden, we just have like a bunch more capacity for semiconductors. Well, we know that's not possible because anything to do with semiconductors takes like 2 years. From when you like start to make a semiconductor to when you actually make that semiconductor, it takes like 2 years, and the actual like bits of the product have to travel like 10,000 miles around like the world to have like the various things done with them before they're ready to go. So there's like a 2 year lag for anything that happens. So if tomorrow a new semiconductor plant comes online or a new foundry comes online or something like that, there's still 2 years before any of that company's components are in like end game products, give or take. Obviously it doesn't have to be exactly 2 years, but just on average roughly. So nothing can really change short term. So there's nothing that tells me all of a sudden, semiconductor space is just going to like reverse and all of a sudden everybody's just like super bullish on it because somebody started to build a plant that's going to be done in 2 or 3 years, like quote unquote the Intel case right now. That's the big pitch on Intel. It's like, okay, they're about to, this $50 billion deal is going to get passed. Government's going to give a bunch of money to a bunch of companies that just made record profits in the semiconductor space. Intel is going to build a foundry in Ohio. It's going to be a ton of jobs and U.S. manufacturing, and it's super bullish. Well, okay, sure. Let's just say, and this has been the talk for what now, 9 months? Let's just say that the U.S. government gets anything done, which they don't. They are fucking terrible, especially going into the future, especially with everything going on. We're coming up on midterms and all that. Everything is split. The likelihood of anything getting done in the next 6, 9, 12 months is bad. Now, obviously, we already saw what happened recently in the last couple of days with this. $50 billion. You want to basically do like corporate handouts, spend that money. Let's say it all goes through and it's all said and done. It's on the right path. And let's just say it happens. And let's say they start building, and what? The foundry is going to be done in what, like 2025 or something? Okay, so then in 2025, they're going to start making products and taking order. That's kind of bullish. And then when is that product going to hit the market? Oh, I'm sorry, 2027, 2028, maybe 2026 if we're lucky. So like, how far are we pricing this out into the future? Like, I mean, it just, and then what is the probability that something falls apart somewhere along the way? It just doesn't, I can't see a bull case short term. Now I'm massively bullish long term in semiconductor. I just don't see a short term bull case for semiconductors. And then when we look at, the technicals, I mean, this to me, now I don't know. I'm just some guy on the internet, but this to me looks super fucking toppy right here. This looks super, super, super fucking toppy. It looks like we just broke down from the 8 and 21, put in a new low, and then we're just back testing that before it flips red, and then we go much lower. Now, I don't know. And this thing stays bullish for a long time. But does this look like, the back test before we go much lower? I mean, this is a really, really bullish chart. And you're like, well, that's the chart I want to be in long term for sure. Especially if we're like right here, or for right here, or right here, or right here, or right here, or right here. But now, with a monthly sell by sell, left the bullish control zone, all red histograms, about to get the 821 to the downside, haven't had the 821 cross to the downside since it crossed to the upside back in 2013. The last bear cross on the monthly was in 2012. So we're about to do something we haven't done after a 10-year massive bull run where we went from $23 up to $247. So we 10x'd, and now the chart looks bearish, looks super toppy for the first time in like a decade. It probably just rallies back up here and goes to new all-time highs. Everything's fine as the dumpster fire rolls by. I just don't see it. I mean, again, maybe I'm wrong. Let's look at, did we just get the same kind of signal? This was March 2020. Okay, we sold off very aggressively, got bought up very aggressively, put in a new low. We did the same exact thing, and then we rallied back up and we saved the cross. Now, it never got anywhere near to as bad. And then obviously this is our 2018. Then we can go back and look at 2014, 15, 2008, 2000. So maybe I'm wrong. Maybe we just rally back up here over the next like 5 days. Maybe we reclaim 186. And then I will say, okay, I was wrong. If it consolidates up here for a couple weeks and looks okay, I'm flipping back bullish on semiconductors because it's okay for me to be wrong. I'll accept what the charts are telling me. But I don't think that's likely. I think it's much more likely we just continue to melt down here. And again, I just don't see the like fundamental case for semiconductor bullishness either. It's like, oh no, don't worry about it. All of the demand, all of the back, demand that happened over the last couple of years because of the supply chain and shutdowns and everything, we're going to fix all that. And then we're going to make a bunch new supply. Demand's going to continue going up. New stuff's going to come online in the future. Economic expansion, everything's going to be gravy. I mean, it's possible. I give that scenario a 25% chance that actually like we avert massive crisis and everything just goes back to like kind of like the new normal or whatever. And we just go back into like melt up bull markets. But it's the timing that throws me off. I don't see it happening in the next couple of weeks or months. Possibly a year from now, maybe 6 months from now. Everything happens so slow in the markets. So let's say it takes 6 months And then all of a sudden the Fed backs, they pivot, everything's good again. Mid 2023, they're revving up the money printers, all the central banks making it rain. Instead of 10 trillion, you know, we see 20 trillion, and it's just, I mean, raindrops and fucking let's go, baby. Melt ups left and right. Like, just, it's going absolutely nuts, okay? Maybe we're getting even more hyperinflation in random countries. I mean, it's just a full-on fucking melt up. And if you got anything, it's worth more every day when you wake up. Let's say that's possible. And it is. There's definitely a possibility for that happening. When does that start? When does it start? Is it 2022? No. Is it beginning of 2023? Probably not. Mid, maybe? By the end of the year, 2023? Okay, maybe. I could see it happening. I could see them figure out a way and kick the can down the road, and we just do it all over again. Mid 2023, late 2023, early 2024. I could see it. But the timing doesn't fit with what the charts are telling us. So I think it's much more likely that the charts are right. We'll see, though. We'll see. We'll see what happens. I mean, obviously, any sort of black swan event, bam, aliens hit. Aliens show up. Everybody's like, oh my God, there's aliens now. Like, this changes everything. So we don't actually need like products anymore because the aliens have a little ray and they can shoot it at something and it duplicates it. And now instead of just, you know, one of that thing, there's two. So we don't need production. We don't need resources. We don't need to make food. We don't need to mine gold. We don't need to make steel or we just shoot everything with the duplicator laser. That's possible. That is a possibility. It's very, very unlikely, but that would be a scenario where everything could just be booming into the future and we could see just a full-on melt up. It's possible. But what's the probability? You know what I mean? What's the probability of that happening? I would say less than 10%. Less than 1%. I would say probably close to zero. So 210 spread. Obviously, nothing has changed here. We're still looking at the 2.78 on the 10 and the 3.0 on the 2. So currently, you know, we are inverted. Now, we know what matters here is one of two things is going to happen. Okay? And the one that happens, I mean, it doesn't happen tomorrow or in a week or even in a month or, I mean, sometime in the next few months, I would imagine. We're going to find out one way or another definitively, and we're going to be able to position ourselves in the markets phenomenally well based on what this chart does. Because we know every time. When we get to this resistance, going back to the 1980s, when we get to this resistance line in white, the descending resistance, when we get there, when we top out and roll over, we put in a new low. So if we top out here, we roll over, that means that everything we talked about earlier, you know, with the bonds and the yields, it's just doing the same thing it did every other time. There was just a little fake out right here. And it's okay. It wasn't a technical breakout. And we're just going back down. We're going to revisit the lows. Maybe even we come back down to revisit the lows. We put in a higher low. And then we start an uptrend. But regardless, we top out. We roll over like we did every other time. And then the white lines obviously represent the recessions. So every time when we topped out and rolled over, we got a recession slightly afterwards. So the bullish case, the bull case, is that we actually top out right now on the yields. That tells us probably inflation's coming down, and that's why the Fed is cut back on the rate hikes. So now this is rolling back over. Inflation's coming down, and then what happens? We go into a recession. So that's the bull case. The bull case is yields come down, inflation comes down, recession. Okay, so that's the best case scenario. Excellent. You know, I mean, or we do something we've never done before ever in the last 40 years. And then the bear case scenario is, well, we have this big descending pattern that we've hit resistance every time and topped out. And now we have broken out of that pattern, broken out more than we ever have previously. And now we're above our previous swing high from the last high of the descending pattern. So we have a pattern where we're consistently putting in lower highs consistently and lower lows consistently. And now we're putting in a higher high. So that's the technical breakout of this. And that tells us, wait a minute, if this starts breaking out, we're likely to retest the last high. So we break through the 2018 high, we retest the 27/28 high, 2008, I should say. And that's 5%. So that means that the Fed is really hiking rates. That means that the bond market was wrong. That means inflation is out of control because the Fed had to go up another. Right now they're pricing in, 3.25 to 3.5 by end of year. And then it rolls over into 2023. It goes down to like 3.2 and then 3.0 and then 2.9. And over like the next, whatever it was, 4 years or something, it comes back down to 2%. That's the Fed dot plot, what their estimate is. So if this is a technical breakout and this is right, if we confirm over 75 basis points on the Fed funds rate, that confirms a technical breakout of this same point right here, but on the Fed funds rate chart instead of the 210 spread chart. So the 210 spread chart already has confirmed a technical breakout, or at least double top. The Fed funds rate is still technically a lower high. So if it rolls over, that's fine. That's our first case scenario. The bull case, which is a recession. The bear case is we break out, we confirm the breakout, and then we backtest the next one, which tells us then if we're at 210, somewhere around 5%, that the Fed funds rate is probably, if we have right now the 210 is at roughly what, 2.75, and the Fed funds rate is at currently 1.58, and it's about to go up to 2.33. I mean, so the spread between that 2.33 and 2.78 or 3 is essentially like 0.4 to 0.6 roughly. So we can look at the relative spread, obviously would be the same around right here, and then we can back it up and look at 2007 and say, hey, what was the Fed funds rate at roughly when the 210 spread was at 5% and the yield curve was inverting, telling us that basically inflation was going to come down or the easing was going to pick back up, etc. So if we look at the let's say 1%, and then we subtract out that difference, we're talking about roughly, let's just say 0.4 to 0.6. So let's call it, 0.6. That's going to put us at 4.5 Fed funds rate. So that tells us, okay, inflation continues into the future. In 2023, there's additional rate hikes. And then at some point in time, rather than inflation rolling back over, rate hikes decelerating, and then actually, rate cuts starting to take place. Well, without that happening, this is our scenario. So it means the Fed's wrong again, the dot plot's completely off, and that actually will be up somewhere around 4.5%, in the next 6 months, 12 months, 18 months, whatever. And I think that's more likely what's going to happen right now. That's what the chart is telling us. We'll see. We'll see what happens. But it's very important to know that, okay, that's our two scenarios though, right? So is there a third scenario that we're not talking about or we haven't thought about or that has a lower probability? Sure, there's 100 scenarios. We can create 1,000 scenarios. But we know there's a very, very high probability that it's going to be one of these two scenarios. So either inflation's out of control 6 months from now, a year from now, and the Fed is wrong, and the Fed funds rate is much higher, and we confirm a technical breakout of the Fed funds rate and the 210 spread, basically all of our yields, on a 40-year downtrend and start retesting, previous highs. That's the bear case. That's the bad scenario because that's lots of inflation, expensive money, pain. The bull case scenario is we roll back over, inflation comes down, CPI tops out, Fed eases, we go back into the same, horrible debt cycle that we've been in for the last 40 years and it just continues. But we go into a recession shortly after. So that's it. That's the two big scenarios I see. And what are 60-40, one way or the other, 50-50. Maybe it's 40-40 and then there's 20% chance something else happens that we can't account for or, just doesn't have enough of a chance that it's worth talking about. That's it though. That is all. That's the base case. So I'm going to jump in the chat real quick. Chat it up with you guys. If you have not taken the chance already to hit the like button, if you're new to the channel and you're like, hey, this shit's all right, might as well subscribe, right? You can always unsubscribe later. All right, CW says, I think we are being told about 100 points, so that 75 doesn't sound so bad. Yeah, it's possible. It's possible for sure. I still think we get the 75. It's possible we get the 100. If we get the 75 and then people are like, well, at least it wasn't 100. Does the market then just rip? Probably. And then they wake up the next morning and go, what am I thinking? That's terrible. Gigabyte, what's up with the emoji? Good to see you. Toby, good to see you. Fire content as usual. Thank you, my friend. Appreciate it. Any views on housing market, especially for first buyer in the U.S.? Man, Toby, it's such a the housing market is weird because it's not like the stock market where you can get on here and there's just like infinite liquidity. I mean, not literally, but tons of liquidity. And you can always see what the price is. And it's universal. You know, like Dow Jones is the same price if you live in Florida, if you live in California, if you live in Kansas, etc. The housing market is weird in the sense that it's very like localized. And we also went through like a record, like world changing event, or like United States demographic changing event, where we saw a bunch of people leaving big cities, a bunch of people leaving like, whatever you want to call them, like liberally run cities or whatever, for various reasons, etc. So without getting too political, you could live in one of these places where a ton of people influx to and it's booming, and realistically, the prices could be up 100% in the last couple of years. That place is more likely to sustain the uptrend for longer, but then more likely to have a deeper retracement because it had a more aggressive move to the upside. You could live in a place like that's, I don't want to call it a dead city, but let's be real. You could live in one of these dead cities where you can literally buy like a 1980s house that, is in livable condition for like 30 grand. But the cities are dead. There's nothing going on there. They're, dying. It's not going to appreciate in value, etc. But, you look at the prices and you say, well, how much has this appreciated in the last 2 years? And you say, well, some houses in some areas went up 30%, 50%, 100%. And then you look at one of these dead cities, and again, livable house that in the right city somewhere else might be worth 100,000, and here it's worth 30,000, and it might have went down or up by 5% in the last couple of years. So it's really all relative. The most important thing, in my opinion, obviously everybody always says location, location, location. It's all about where you put a business or where you buy a house or whatever. There's some important factors, in my opinion, that are very, very important. One, you said you're a first-time home buyer, so that's important. 2 is, how long are you planning on staying in the place for? And then 3 is, are you buying the house for somewhere to live and that's your main goal? Or are you buying the house with hopes that it's going to appreciate over time? Because a house really is a liability. People look at it as an investment and it's a store of value and all that stuff. But in all actuality, a house is a depreciating asset, theoretically, that's like a liability over time. But if you buy it in the right area, the appreciation can make up for, the upkeep costs and everything. Or if you cash flow it or something like that, whether it's just a straight up rental or whether you buy a duplex and you live in half of it and you rent out the other half, there's lots of factors that can still make it a good idea. Especially with like United States, how the tax code works. Obviously, none of this financial advice. I'm not your tax attorney. You can go see, an accountant or attorney or whatever for any financial advice. But, you can live in one half of it. You can rent out the other half. And then down the line, assuming it appreciates in value, you can either sell it and not pay taxes on that because you actually lived in part of it for a while. Or you could potentially, cash flow the other half and then move into, your dream house. Or, there's lots of situations where it could be beneficial. But the truth is, right now, we're in a situation where most places in the United States, most places in, I don't know as much about it, but obviously I've heard Australia, New Zealand, Canada, lots of other countries around the world, where they're at not only record high prices on real estate, but they're at like, not all-time record high, but like relative to like the recent past highs on mortgage rates. So the last thing you want to do is buy an expensive house with a high mortgage rate, because then you're basically asking for it on either side. You're either paying a bunch more over time because the rate is higher than it's been historically, which isn't actually that bad, because theoretically, if rates are going to continue to trend to the downside and eventually come back down, maybe it takes 6 months, a year, 2 years, 5 years, but you can refinance it. In the United States, we have like 30-year mortgages. You could refinance it after 2 years or 5 years or something like that, get a much lower rate, and then it's not as big of a deal if you overpaid a little bit because you're getting a better rate. But if you overpay for it and you pay a high rate, it's much more difficult for you to recoup if the price of the house goes down, because you're essentially fighting that. So if sure, you can refinance in the future, but if you bought in the last couple years and say you're break even or you're up a little bit, and then all of a sudden it turns on you and it goes down by 20%, now you have paid too much for the house and you have a high mortgage. So even if you refinance your mortgage down the line, you still overpay for the house. So the idea of it ever appreciating in value, at least for the short term, if you're going to live there 5, 7, 30 years, maybe it's worth it. But if you're going to live there 2 years or 5 years or whatever, you're going to end up upside down on a house, refinancing and paying extra money for that. And then you can't get back where you need to be. So in my opinion, the most important thing is, especially historically, if you think going into the future, the powers that be are going to go out of their way to make sure that we still have low rates into the future and we still see economic expansion and the system continues to exist as it is and we keep kicking the can down the road, which seems the most probable situation. So the most important thing to me then is don't overpay, because then you can refinance later. So you might get a great deal, but at a high rate. But then later on you can refinance. So you still got a great deal and now you're at a low rate. So that's best of both worlds. But if you overpay and you're at a high rate, sure, you can refinance later on, but you still overpaid. So even though you can kind of do some like damage mitigation in the future, if rates do come down, you're still upside down on the price of the house, or you still overpaid. But again, if you're just going to live there for 10 years while you save up for your real house and you're going to cash flow half of it because you got a duplex, and who cares what you paid? If you're not buying it to live in and you're just going to straight up cash flow it too, it's the same thing down the line. It doesn't matter what it's worth. If you're going to get, $2,000 a month out of it, and, you paid $250,000 for it, and who cares? But again, there's just so many factors to it. And depending where you live and what the market has done, it makes more sense to like find a real estate guy, online, whatever, and or somebody that's got their finger in the local market and can give you a better idea specifically of your area. But in my opinion, the number one priority is don't overpay. And the reason the prices are so high right now on houses is because money has been so cheap for so long. So now the cheap money trend is ending. So we would expect the high prices to end as well, or at least roll back over and see some kind of correction. So that's what I would be looking for if I was looking to pick up, a property to live in. And then what do we got? Bullish on aliens, says K. Ols. It depends, man. Depends what kind of aliens. Are they the good kind? Are they the bad kind? Is there a good kind? Like if they're like the ET aliens, sure, man. But if they're like Independence Day aliens, I don't know. I want to go down that path. I don't know. All right, so on to the Dixie. So, obviously everybody's sitting here calling the top on the Dixie. This is the top. Now it's a top. Dixie, top, whatever. We'll see what happens. I've been through this a million times. We see what's happening. What's happening? Well, we should be going down because we're topping, quote unquote. And instead, we're just going sideways. Now we're between the 8 and 21. So sure, we could definitely just fall right out of bed here. But we saw the last two times we got a correction. The indicator oscillator trended down aggressively and price action basically went sideways. A little down right here. So what do we expect? Continuation to the upside. When we look at the weekly, daily looks a little toppy. Weekly, sure, it's a little tired. But the 200 exponential is about to cross over the 200 simple. It's literally the most bullish time ever for the trend. Bullish control zone. 2 red histograms, still blue slope line. Looks like it'll cool off for a little bit. A little tired on the weekly, but I wouldn't be calling the top. I'll tell you that much. Says the guy who called the bottom. The monthly chart is bullish as hell too. It's the parabola is increasing to the upside. Now, what do I say if 5 days from now price action sells off and the dollar's at 105 and you're like, oh, it's a giant wick and just a little red body right here? Sure, maybe it's a rejection. Start looking like a rejection for sure. What if it just pushes back to the upside? And next thing you know, we close the monthly and we're at 108. I'll say, well, that's a big green candle, so it's bullish for sure. Right now, I still give the wave to the bulls, honestly. Bullish control zone, all green histograms, blue slope line. Everything postured as bullish as it gets. The 8, the 21, the 200, the 200. This is the most bullish posture we get on the monthly. And we just took out the highs, and we just retested for the first time since 2002. So what does it look like we're about to do? I think we're coming right here. And again, we've done this a bunch of times, but if we look at our fib from the all-time peak here in 1984 and then the peak here in 2001, what are we doing? We're just hitting the 0.5 in red and the 786 in orange. We're just hitting key resistance at our target to the upside. And then what happens? consolidate for a little bit, and then we go up to our next target. We retest, we backtest the previous high. So we're basically just doing, breaking out of a long-term downtrend. So the dollar has obviously confirmed that break with a backtest right here in 2018, and then a higher low with bullish divergence, and then a shot to the upside. So now we've broken out of this descending pattern, this descending wedge. That's bullish. Now, eventually we put in a lower high and then go down from here. Does the dollar go to zero eventually? And sure, I don't care. It's way, way out there. Way out there. I mean, I'm not worried about what the dollar's going to do in 10 years when everybody's calling the high right now. I'm like, let's see where the dollar's at in a month before we call the high. Well, it's consistently putting in higher highs and looks extremely bullish. So Tesla on the daily finally got the move back to the upside. Obviously, kind of kicking myself on this one because I did move my stop and get taken back out before the remainder of the move played out. But to tell you the truth, it's going to happen sometimes. Stick to my strategy. I'm not going to all of a sudden change my strategy now. Of course, if I could go back in hindsight, I'd be like, well, I just wouldn't have moved my stop loss. And it would have never been upside down. And then I'd be up on this trade. Sure. Hindsight, 2020. It is what it is. So back tested the 200. Nice test right there. Still ways off from a 200 simple. Still got some other key areas right here. Did put in a little bit of a bearish candle on Friday, but nothing crazy, especially after that massive candle on Thursday. I imagine this is probably some Nancy Pelosi options trading going on right here. Probably blew this thing to the upside. I heard her and the hubby are a fan. Neo rolling over, confirming back to downtrend. This looks like a bear trend. Reversion to fair value and then continuation to the downside. So the key areas to watch are, obviously, we take out the previous swing low. We take out the previous cycle low. Those are the two areas. Looks like quite a bit of downside. I mean, it had a nice aggressive move back to the upside. It's 16% before you find out if we're breaking to a new low. And then it's another, total of 35% before we say, hey, this is a new cycle low. So this thing could do a lot of damage. I mean, it had a nice run back to the upside. It could do a lot more damage and go to new lows. And that's what I expect. Baidu's holding up slightly better. Obviously lost, the potential flip of the trend right here. Hitting resistance right now. The longer we spend under here, the more likely we are to break down. I do like that it's just kind of hanging out while the indicator's trend down, though. Maybe we're going to get some kind of bullish reset, reclaim these levels, and then start moving back up. In which case, the bullish case is we take out 156 on a daily close, flip the 200 exponential and simple bullish, and this starts looking juicy. So still got China in the crosshairs. Wait, maybe not. Still got my eye on China. Sounds a little less aggressive. Don't come after me, China. See what happens. We're at a pivot point. Seems like we're just going to pivot and continue to the downside. But I'm still not ruling out the ability or possibility that we actually are going to get back on top of the 200 exponential and simple. And you guys know what it is. When these flip back blue and we're back on top of them, I don't give a shit. It was the same way with Bitcoin. Even though I thought we were going to go lower, which we did, I still took the play to the upside and just trusted the technicals. And it played out nicely. I mean, we did like 30 or 40%, depending on the altcoins or Bitcoin on that move before we went to new lows. And then eventually capitulated to that 20K, 18K, 17K. NVIDIA still in play right now. We don't want to get too greedy on this. So hopefully it gets up to 200 or just under 200. I always like to take profits a little bit early, especially on even numbers like that. We tend to either like undershoot and we'll go to like 197 or we'll overshoot and go to like 208. But it never like just hits 200 and then just like, all right, everybody exit the bus in an orderly fashion before we continue to the downside. But that is what I expect, continuation to the downside. What happens if we extend this out here? It kind of looks like we're still fucking with it. That looks pretty good. And we didn't quite get there on the way up. I think something like this actually looks pretty good. So we kind of had this little breakout underperformance, and then we failed to hold that level. That was right around when we were like back testing to try to save the bull trend. And then we confirm bearish, underperform. Here we are back outside it again. Maybe we get the push up here. The trade setup completes. We back test the 200s, and then we go lower. And then realistically, there should be like, maybe something like this. One more resistance. Obviously, we don't have two touch points, so I'm just kind of throwing it up there like just parallel to this. You know, and then maybe when we look at it into the future, we'll say, oh, well, actually, this is the channel. Oh, okay, see, look at that. That actually, you know, and again, we're just spitballing right here. We're just throwing around some ideas. But, I mean, if that doesn't look like a pretty technical channel. All right, so now, again, this is hypothetical because we only have one touch on the top. So we need at least 2 touches for anything. But if we just use the horizontal, or I'm sorry, the descending support on the bottom right here, you know, we can see we basically have like 1 touch right here, 1 touch right here, 1 touch right here, you know, close right here, but not quite, and then a few touches right here. So we have multiple pretty clear touch points on this. And then look at the heart line now. You know, this is very clearly acting as resistance the whole time. We break through resistance, we come all the way up. Now we have a top, and then again, we see the heart line, resistance, resistance. You know, maybe we back test for support right here, and then that's our push back up to the top of the channel, the 0.5, the completion of the trade setup. Daddy gets his nut, and we're out like trout. Okay, we pull, we pray. You know, put a couple bucks in the church offering plate, you know, or drop it to your favorite charity, whatever. Feed some stray cats. I don't know. Do something good in the world. You get my point, you fuckers. But anyway, that's actually, I mean, I'm just, you know, we're playing discovery on the spot right now. Maybe this is all trash and I'm just making stuff up. I don't know what's going to happen, but it sure looks like that's a possibility. So I think for NVIDIA, let's really watch this area right here. Obviously, that's already our take profit. So sure, we played discovery. We drew some new stuff on our chart, but did anything really change? No, it's still a 0.5. It's still a 236. It's still a trade setup target. It's still 200 exponential. But we just have one more piece of confluence. And now maybe into the future, after this move plays out, maybe we'll be able to look at this descending channel and say, oh, look, you know, more confluence somewhere else. So we'll see. But it looks pretty damn good to me. Daddy likes. All right, so on to AMD. So just descending, broadening wedge. There's not a lot more we can add right here at the time. You know, backtesting the 236. It's not as clear as NVIDIA. And honestly, I like NVIDIA better than AMD. So, you know, I'm more biased towards like trading that. But essentially the backtest would be somewhere in between like 94 and, you know, $100. So we're almost there. And then again, we would expect probably to roll over somewhere off that resistance, something like that. Apple had a beautiful move up here, back in between the 200 exponential and 200 simple. Both have blue slopes still. So is this just a back test before we enter a bear market? Probably, based on like the other like 2,000 stocks in the market. But if we didn't look at the other like 2,000 stocks, we just looked at Apple, and it was it. And we didn't have any other references, no other charts, no other idea what the markets were doing. We didn't have any other tickers to look at, and we just looked at Apple. And we said, okay, are we bullish or bearish right now? Well, we've been in a long bull trend, a long bull trend. You know, arguably, depending on if you want to count that as a little flip or not, we've been in this long bull trend since 2019. Very aggressive. Every time we've bought the 200 exponential, it has paid in dividends. Now here we've broken below it, confirmed into a bear market. One of two things happens. We either get rejected here, confirm the bear market, and go much lower, or you know, we get back on top of the 200 exponential or simple, go higher, back test for support, and then we go higher again. So this is the same move. We're bearish right here. We break out to the upside. Now we're bullish. We back test to make sure we're bullish. It holds. And then we take out the previous high. And then, you know, bull trend confirmed. So this is the exact opposite move. We've been in a bull trend. In the other case, we were in a bear trend. We break out of the bull trend into the bear trend. And we back test to see, are we still bullish? Can we reclaim this level? Or are we going to be bearish from here? Here's the breakout from the bearish trend into the bullish trend. We backtest. Are we still going to be bearish? Are we bullish now? And then confirm bullish. So here we backtest, we get rejected, and we confirm bearish. Likely see much lower prices in Apple. Probably a revisit or new all-time lows. You know, Apple obviously had a shallow retrace to 236. I think it's likely we come down here to the 382. So obviously that has and is still our target. Do we have to get there? No. We know what's going to happen, though. We either consolidate up here, flip back bullish, and we go to new all-time highs, and it's game on. You know, just like what we saw happen right here, or here, or here. Or the bear scenario happens, and again, this is where having access to thousands of other charts to look at, and they all look like shit, is nice. We can say, well, probably, actually, we get rejected here and just go lower. So we'll see what happens, but I'm not bullish on Apple here. You know, you could be bullish on Apple here. We're bullish on Apple here at 137, but not at 150 plus. No thank you. Matter of fact, I really do think we're going to 120, maybe even 100 on Apple. We'll see. Before, you know, a while plays out. Google, so still just playing out. We have this leg in, then we have this ascending channel. Just to make sure that people know, because I know there's a lot of fake TA out there. When you do the lead in leg, like we did right here, the proper way to actually do this is you take the lead in leg right here, okay? Oh, matter of fact, this is a perfect opportunity for us to talk about something from the group, actually. So we take the lead in leg right here, we consolidate inside the channel, and then if you're a retard using fake TA who doesn't know what they're doing, you put the leg from the top of the channel outside the channel. If you're an actual human being who knows how to do technical analysis that's not a fraud, you put it from the breakout. Like always, every time you have a breakout, I don't just take the measure move and say, okay, so the measure move, I use it from the top of the channel to the bottom of the channel. So if we break out from the top of the channel, we should come down to the bottom of the channel. What use is that, retard? We're just trading in the range then? No, you take the measure of the channel and then say if we break down from here, from the bottom of the channel, that will be and the same thing if it was the top of the channel. If we were in this channel and then we broke out from here, which is less probability of happening, but always possible, we would take it from the top of the channel. We wouldn't say, okay, now from the bottom of the channel to the top of the channel, the breakout confirms that we're back at the top of the channel. And then guess what? We break down again and confirm we're at the bottom of it. No, fucking morons. So be careful of people doing fake TA. You take the measure move from the breakout point, not from the fucking top of the channel, from the breakout point. Okay, and then there is an example. Actually, I want to go off on a quick little tangent here right now. I talk about the fib tools all the time. And there was some questions about the difference between the fib tools. So without getting too crazy, when we're doing an internal retrace, it doesn't matter. So for instance, if we're going from like the top right here to the bottom right here, here we're going from the top to the bottom, the retrace is going to be the same. So here it's the 382, the 0.5, the 618, etc. So now let me grab the other tool and I'll just show you. So we would be going into the trend right here. You would go from the bottom of the last swing to the top of this swing right here, and then we would draw it to the bottom right there. So it's still the same internal retrace, but the difference is that it uses the distance of the leg to calculate the retrace. So as I move this, it's different. You see that? So for instance, that's when it's the same and the numbers would line up essentially. But now the way you would properly actually do it, let's say for instance, is if we were getting like an A, a B, a C correction, this would be say our A down and then our B up and then our C down. So let me actually put that in place so it makes more sense. So from our top to our bottom, and then our internal retrace of the A is the B, and then our C would take us lower. What we would use the tool for now is, if we were doing the fib retrace from the bottom right here to where we're potentially going for our top, that's our internal. And then where we go from here is the external fib. So our normal fib tool is using the range from the bottom right here to the top right here to project the Fibonacci extensions. So it's using this distance, the distance of B or from A to B. As where the trend-based fib extension is using the leg in, so from the top right here down to the A, and then when we put it up to the B, this is what's using the Fibonacci extension or the number, the distance that's being used to calculate the Fibonacci extension. So essentially what it comes down to is it's the difference between if the fib extension is of the little move right here from the bottom to the top, or if you're using the fib extension of the move right here to the bottom of the top. And the reason why you would do that is essentially if you were trying to use the leg to calculate the distance, a 100% fib extension from here to here from the breakdown would just be an equal leg down, which is essentially just the measure move. As where if we're taking a leg down right here and then we're using the fib from here to here, and a 100% extension would just be from the bottom right here to the top, back to the bottom, and then the actual extension would go down. So here we see obviously this leg in is longer, so the move will be longer because this would be a 100% move to right here. So hopefully that helped clear up some questions in the group. You can keep it simple though. You don't need to use anything fancy, honestly. It's just about adding other tools to your belt and kind of sharpen them up over time. So that being said, Google just trading inside of this little channel at the bottom of the channel, lightweight breaking down from here or very close to breaking down from here. Maybe if we just go by the closes, see if it's like a technical breakdown. No, okay. If we go by the closes, it's basically just like hanging on for dear life. But again, the leg down, a bearish move, a bullish consolidation, typically followed by another bearish move equal to the length of the lead-in leg, which arguably you could say, you know, and I'm just using the conservative lead-in leg, you could arguably say, well, actually, the leg should be from the top to here. So you could say, you know, it should be even more than I had. But again, I always prefer conservative targets and taking profits early and often, locking in those gains. So that's Google. Again, looks like it'll chop around for a little bit. Already had the split. Earnings coming up. We saw, you know, advertising issues, obviously with the Snap and 35% of your values gone. So we'll see if that reflects in some of the other big tech. You know, and these are big portions of the market. So if there is some kind of issue, you know, that would reflect in earnings, therefore valuations. So Amazon basically backtesting the 0.5 at resistance right now. A breakout from here, essentially looking like a double bottom or a breakout of an ascending, or I'm sorry, a horizontal channel, which should take us back up to like the 200 exponential or simple, the 382 or the 236. It seems very likely we would get a push back up to like 136. Again, I would be so much more bullish on all these setups if we weren't running out of time. So like what do I really want to see from the markets? I want to see 2 days of extreme bullishness, a bunch of trade setups pay out, everything pops off to the upside, we act like there's nothing wrong, everything's gravy, and then reality sets in, you know, Fed funds meeting, rate hike, you know, back to reality. I don't know if that's going to happen. We might just kind of stall out here, and then the bad news hits. We might stall out, and then we get a 75 basis point hike, and then we get a pop up. The best case scenario right now would be if this shit was actually moving, and we weren't like down to our last couple grains of sand. Microsoft still very bullish overall, longer term time frames, but looking like we're about to backtest. I mean, we've already basically had a sort of backtest, lower high. So now maybe the full backtest, this plays out and then rejection and we go much lower. But we see that some of the stronger, big market cap, you know, tech stocks are now actually confirming into bear markets as well. So if they really flip, they're going to lead the market to the downside the same way they led the market to the upside. And again, that might have to do with the big surge in VIX. Lots of options expiring, getting towards the end of the month, getting towards, you know, key fundamentals. Twitter hanging out at support. Nothing really changing here. I expect this to just kind of chop sideways. I mean, it could literally just go sideways until February 2023, and it would just be trading in between, you know, the 382 and the support. So, I mean, I know it sounds crazy, but this probably just does nothing for a while and just kind of chops. Meta getting a pretty aggressive bounce off of the lows right here. So that's a back test of the macro 236. If we go way back to 2012 and we fib from the low in 2012, it was like $18 up to the high at 375. We're back testing the 236. It acted as support. Now it's acting as resistance. Eventually got rejected. We're going to the 382, which I'm not sure why we don't have a target there, but we should. So somewhere around here, obviously a big macro target. Come back down. Basically the next leg down. So slinky theory. Down 2, up 1, and then, you know, down 2. Or in this case, you know, fib levels 1. But we'll see. That's what I think is going to happen. You know, is that going to be the buying opportunity of a lifetime and your chance to snag up some sweet meta? Yeah, maybe. Maybe. All right, let's look at our cryptos. So we saw a little run up over the weekend. Nothing big. Little run down, little run up, right back where we started. Close that gap, and now we push back down. We were very close to confirming the 821 cross on the daily. Well, we actually did confirm it, but now we're close to unconfirming it or just confirming the cross back down. And what does that look like? I mean, it's a failed cross. Maybe we get another failed cross. Maybe we get a real cross and then a rejection. Maybe we cross back to upside and it's bullish, and this is just a back test. We don't know what's going to happen. We know there's a big knife stab here on the daily. It seems likely that this is a bearish reset taking place. The indicators are trending back to the upside while price action basically goes sideways. It's not as bad as this one was, but I still don't love how this looks. Crypto had a nice run up here over the last few days. It's obviously a big time risk on asset. It's obviously not a store of value or a medium of exchange, or at least very good at it. So in all reality, what's going to happen? I mean, if we go risk off again, this thing's going to melt down probably to new lows. If we go risk on and everything's gravy with the Fed, we probably go back up to that 28K. I mean, we still have our bullish targets. We still have bearish targets. I don't like how much energy this has used up to basically do nothing. Because at this point in time, what does it look like? I mean, look, this high right here is at 31K. This potential swing high right here is at 23,675. And then we look at the stochastics. This is our previous high. This is this high. This is the knife high from the previous high. This is this knife high. Well, you're like, well, what's wrong with that? I mean, it's not like we have massive bearish divergence between these two peaks or anything. Not like we have a high right here and a lower high right here and a high right here and a higher high right here or anything. Not like there's more bearish divergence in a massively bearish trend that's been going on for years while we're under the 200 exponential moving average after a pathetic attempt to cross back to the upside right before a huge Fed rate hike of 75 basis points while we essentially confirm into, stagflation and, essentially confirm a recession, record high CPI data. I mean, I don't know. But it's probably just bullish. We'll see. We shall see. What does it look like on the weekly Bitcoin futures chart? It looks like we backtested the 200 exponential, backtested the 200 simple, backtested the 8, and it looks like we got rejected, closed underneath them, and we're essentially going to go back down and revisit the lows. We're in the bearish control zone. We do have a bunch of green histograms. So there's one good thing right now. We have multiple green histograms on the weekly. Everything else extremely bearish. But if you just put everything aside and say, but we got some green histograms, actually not bad. If you just don't trust all the shit that always makes us money, it's actually looking pretty good. I mean, that one thing. So we're 3% bullish. I'm all in. Hooray. Well, I lost all my money. I should have bet on GameStop. Monthly chart, again, wanted to see at least 50% of this red eaten up by some green. So maybe we get back up to like 25K and close the monthly out there. We got a couple days. We'll see what happens. The end of this week's going to be big, obviously. I mean, there's a lot going on this week. It seems like there's always so much going on, but this week there's a lot going on. A shitload of big companies reporting earnings. Fed funds meeting. Or Fed fund hike / meetings. On to the Bitstamp chart. Looks very similar. Obviously, the daily, we had a little more bullishness here. We kind of rolled over the last couple days. So we were talking about, obviously, have a trade setup in the group that we have been. So what we were looking for basically is, I'm on the 4-hour now. I know I don't really like doing the longer, shorter time frames, but I know you guys appreciate it sometimes. So what we're looking at right here is from that previous swing high right here in white at 32,000 to the low down here at 17.6, the all-time low or cycle low. And then we have the internal fib in white. And then if we just kind of zoom over a little bit, we'll see from the previous high up here, not the all-time high, but the previous high at 48,000. That was the swing of the 2 to the bottom of the 3 again at like 17,000. That's our fib here in blue. And then we notice the 236 in blue and the 382 in white line up perfectly right here. And the 382 in blue and the 618 in white line up perfectly right here. So what we're looking for is basically a back test of the 236 and the 382, which is also the 200 exponential on the 4-hour. And then if that holds, as support, that would give us our next push to the upside through the 0.5 in white where we already tagged, up to the 618 in white and the 382 in blue, which is our 25,700 target. We still have obviously some targets to the upside, up as high as 33, 34,000, but that's what we're basically looking at for right now. If we go higher than 34,000, it invalidates our 5 waves to the downside because the 4 will have retraced too deep into the 1, therefore invalidating the Elliott wave structure, and it would look like a technical breakout with continuation to the upside and probably resumption of the bull trend. Now, when does it happen? 3 months, 6 months, 2 weeks, I don't know. Does it ever happen? Probably not. But, that's our invalidation point. And it's important to constantly play these mental gymnastics and say, hey, when am I wrong? What's my invalidation points? What areas are key? And then that way, if we get to those areas, you're already ready for it. You say, oh shit, actually, if we go any higher from here, I was wrong and I'm flipping bullish. And that's great because I'll make money because I don't care if I'm wrong. I care if I make money. Or you can just be one of these fools who just sticks to your guns and, just hunkers down and just picks a bridge to die on. And instead just don't make money. But eventually you could be right after 20 years. You get your moment in the sun. Everybody talks about how you called it. Some people mention maybe I've been calling for the Great Depression and the death of the dollar for 20 years. So if it does happen, are you really right? Or is broken clock right twice a day? I'd say probably the latter. So anyway, Bitcoin 4 hour. So we have basically a clear defined area here. Obviously, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. If you take this trade setup, you will literally lose all your money and you will be living in a van down by the river. Okay. And I'm not talking about the good kind. Okay. I'm not talking about some Mercedes van that's fixed up. I'm talking about the Chris Farley living in a van down by the river. Okay. Not the good stuff. So depending on how we look at this trade setup right here, the back test of 382, if it holds, what is our invalidation point? Okay, so if we start breaking to the downside, if we take out the 236, what are we going to go by? Well, typically we want to go by either the 236 or the previous swing low. It's going to give us an 8.8% stop loss from where we're at right now. The target to the upside initially would be that 618 or the 382 we just talked about, 16% upside. That's only a 2-to-1 risk reward ratio. So not ideal. Okay, now if you look at a 4 hour, you're yeah, but we're in a bull trend because we're above the 200 exponential and above the 200 simple. So we're in a bull trend, so we could take 2-to-1 risk reward ratio, right? To which I would say, arguably, yes, you have a point, but if we look one time frame longer and look at it, we're very clearly in a bear trend. So you're so which one is it? Because I'm not trading on the daily. I want to trade the 4 hour chart, in which case I would say, that's fine. Go ahead and do that. But you want to have at least 3-to-1 risk reward ratio because you're still trading against the predominant trend. Now, could you just say, well, fuck it, I'm going to throw caution to the wind and I'm going to take this one trade setup at 2-to-1 risk reward ratio? Or I'm not even thinking about taking profits here because I'm that confident that we're just going to overshoot to the upside. And actually, if we get all the way up to here, we're really going to go all the way up to here. So really, the trade setup is 30% upside and 8.8% downside. So it is 3.28 to 1. So I can take this trade setup anyway without feeling guilty. To which I would say, viable argument. Viable argument. And then realistically, you could even say, well, there's actually a bunch of shit coins that I'll be trading. And that really, if this starts to play out, I'm actually going to be trading shit coins. So I'm going to make way more than 29% or nothing if they don't move at all. But that's what I'm looking at. So there's definitely some possibilities here. This is the key area. Obviously, when we were tapping out the 0.5 right here, and we're talking about taking profits on some of the alts and everything, took profit on some Bitcoin, etc. Obviously, have already taken profits on the Ethereum trade as well, even though it actually is holding up pretty well. But the fact of the matter is, we hit the 0.5. We had the target back to the downside to reaccumulate off of the 200 exponential. If it goes down to 200 simple, still a buying opportunity. So arguably we could ladder in our buys, throughout this range right here. And then we could actually run a pretty respectable stop loss where if we close below that previous swing low at 20,000, 19,225, that would actually take us out. So in all reality, what should we do? That's what we should do. We should have essentially 3 different entries or 5 or 2, whatever you want to do basically, where you have essentially one where we're at right now because we hit our target. So we want to enter with some of our position because that was our target. The market gave us our target. So we should take the trade. And then realistically, we have another entry halfway down, another entry at support or something like that. And then we say, okay, then maybe if we get the minimum push up here, it's 22% with that 9% stop loss. But again, we're arguably in the daily bull trend or the 4-hour bull trend. And then realistically, if we get the big trade, it's 34% instead of 29%. Still the same stop loss. But now it's a breakdown from this ascending support. And realistically, we could put in a low along the way and say, well, really, if we lose this ascending support right here, we're putting in consistently higher highs and higher lows. So if we break down from that support right there, which is essentially where the stop loss is, also the 236, also below the 200 simple, we don't want to be in this trade anymore if we start closing below here. So in all reality, we're looking for an entry, lower, probably down here or at 15,000 or whatever. So we'll see how it plays out. Again, if we still had a month before the Fed meeting, or there wasn't a Fed meeting at all, or the markets weren't acting like little bitches, when there's a Fed meeting coming up and just waiting and doing whatever, it would be a different scenario. But I'm just a little more hesitant to get bullish on some of these trade setups, especially when there's so many nice trade setups. Usually what we'll see happen is some of them will start popping off. We'll see like one trade setup pop off, then another one, then another one, then another one, then another one. And then all of a sudden there's 5 popping off at a time, and then 10, and then 20, and then everything's popping off. But we're not really seeing that. Like, we've had a couple little run-ups in some cryptos. A couple stocks ran up off their lows. We're getting some technical breakouts, sort of. 2 grains of sand left in the hourglass. I don't like it. So daily, we see what's going on here. A little difference between what we're seeing on the futures chart and the spot chart. If we go out to the weekly, very similar. We lost the 200 exponential, red slope. Not good. Lost the 200 simple, back tested it, got rejected like a little bitch. Not good. Couldn't get back above the 8 on the weekly. So we're below the 8. We're below the 21. The 200 exponential is red. The 200 simple is damn near flat. I mean, it's basically going sideways right now. If we stay under here for any longer, nothing has to happen for us to be bearish and put in new lows. Nothing. If nothing happens, the moving average will push us lower. We will go to new lows, and we will break down. So the bears need do nothing, and we continue to be bearish on the weekly. But if the bulls want to reclaim support, they need to break above where we're at right now. They need to get back above the 200 exponential at 26,700. That will put them above the the 8 and the 200 simple, back above the 200 exponential, and arguably the 200 simple at the same time, the 21 rather, and the 200 exponential, somewhere around like 28,000. So that's the real area to watch. We need to reclaim 28,000, and we need to do it soon. Will that happen? I mean, I don't know. We'll see. I mean, it's not that crazy to think we could get back up there. And that's why we have a nice case for, 26, 27, 28 top. We have a nice case for a, 30, 32, 34 top. We have a nice case for if we just go to the upside and new all-time highs. We have a nice case for if we get rejected here and new lows. So we pretty much have planned ahead for anything. Monthly chart, cross down. We know about the potential of this being an absolute bottom. We know we want to see at least half this get wiped out. We know we have all red histograms, red slope line, and accelerating trend to the downside, very close to the bearish control zone. And we know that this is potentially us doing something we've never done before. Oh, and also, again, about like the fake TA and like just stupid people out there that are just faking that they actually know what they're talking about. It's like basic math, and I know you guys all know this. But part of the reason we use the certain moving averages we do is because when you switch out to different time frames, they still like reflect other moving averages. So for instance, if somebody was talking about like, just say out of the blue, like say a 50 monthly all of a sudden, and acting like the 50 monthly is like really important, and like, oh, if we break below the 50 monthly, this is like a big deal and all this stuff. Well, I mean, what is a 50 monthly? What is it on the weekly? 50 times how many weeks are in a month? 4. So it's a 200. 200 weekly is the 50 monthly. It's not, you didn't like discover some great moving average that like changes the world. It like blows my mind how people like don't make these connections. So anyway, the 50 monthly is the same as the 200 on the weekly. Obviously, anyone can do basic math. You didn't like hack the system or something like that. You didn't figure out some new amazing moving average and some great strategy, and no one's ever discovered the 50 monthly. I used to use the 50 and the 55 as well. on one of my other indicators, and they work well. They just clutter up the chart too much. So this is the condensed version of the strategy, but I have like a Guppy strategy essentially. I also have like the PSAR with binary pivots. Check out some of those other indicators. They're freaking awesome. And you might like them better than the master. Me personally, I like the master because it's so simple. And then also, obviously, you have to be a group member to get the master. So if you're not, check out the other ones for free. Yeah, they're down in the description. So Ethereum on the daily. Basically got our measure move. Broke out of, what amounts to like the heart line of this giant descending broadening wedge. Consolidating at the top of the range. Looks okay. Consistently like trending higher. Bullish control zone. Bunch of green histograms. Looks a little tired right now. So maybe it loses this area, breaks back down, and back tests the breakout of the channel around like 1250. It's trying to be bullish though, honestly, on the daily. Short term, it's definitely bullish. We go out to the weekly though. We see it's a little more bullish than Bitcoin. Obviously, Bitcoin was stuck below the 200 simple. ETH is already back testing the 200 exponential and closing at it. Much, much more bullish. Looking close to a hard buy signal and leaving the bearish control zone. Bunch of green histograms. Again, if I didn't see any other charts in crypto and you just showed me the Ethereum chart, I would say it doesn't look so bad. We probably bounce this area and go much higher. But that's Ethereum. Every other crypto like pretty much looks like trash. Bitcoin dominance on the weekly. So we ended up pushing back up here, getting rejected and closing down below it. Very clearly have closed down below the slope line here. So to tell you the truth, I think what happens here is we probably revisit the heart line of this channel or the bottom of the channel. We'd likely, at this point in time, this chart's telling us there's a good possibility we actually are going to put in a new low on Bitcoin dominance. For some reason, I still don't think it's going to happen, but the chart is saying that that's likely to happen. So either Bitcoin is going to sell off massively and alts are going to hold up, or alts are going to go on a massive run in comparison to Bitcoin, according to this chart right now. Again, for some reason, I just don't believe it, but the chart's saying it. So maybe, I guess honestly, I think if this chart is right, and let's just say I'm wrong, okay? I know it sounds crazy, but just hear me out. What an arrogant bastard. Just hear me out. What if this chart's telling us the truth, and we're actually about to get a big, juicy, red candle to the downside on Bitcoin dominance? And what is that actually telling us? Well, what it's telling us is alts, one alt in particular, is about to have a massive bull run. And it's actually going to be so bullish that it alone, maybe with the help of some of the other scam coin, trash bag altcoins, maybe is going to actually steal 4% of Bitcoin's market cap. So we're going to see a big red candle right here go to a new low on the Bitcoin market cap, all because this one altcoin is finally going to have its day in the sun. And I know what you're thinking. You're thinking, what altcoin is this that you speak of? Tell me more. Do you have a trade setup? Is there something in particular that you're bullish on? And what I'm going to tell you is, it's important that you know this stream is brought to you by Ripple. No, I'm just kidding. You thought XRP was going to be the new world reserve currency and it was going to go up. No, I'm just kidding. But let's say there is some kind of like black swan event. Ripple wins its case in court and all of a sudden it shoots up to like $2 per XRP-ness, and it just, we get a big red burst on the Bitcoin dominance weekly chart. It's possible. Maybe it's not XRP though. Maybe it's Dogecoin. Maybe the U.S. government declares that they're going to back the U.S. dollar with Dogecoin, and they swoop in and score up, a couple trillion Doge. Something like that. It's possible. Do I think it's likely? No. Do I think this chart is going to be right and I'll be wrong? No, I think I'm going to be right. I think this is just like a little bump here. Now, what would tell me, okay, stop being stubborn. You're wrong. Just admit it. And I'll be like, fine. If we take this out, I'll really admit that I'm wrong. I'll actually admit it. It's my line in the sand, okay? So if XRP bursts to the upside and I get proven wrong, we know it right here. at 41.46%. Really, if just XRP ever looks decent, I'll just admit that I'm wrong. So I'm that confident. But we'll see what happens. We'll see what happens. Crypto market cap on the weekly, back testing the 200 exponential. Again, just looks, I mean, what was the difference? Like the Ethereum overshot to the downside, back tested, and then bursted up here. Bitcoin broke down from here, back tested, and still under 200 simple. You know, this has been more bullish than crypto itself for a long time now. And now basically this looks like the Ethereum chart, actually a lot better than most. And then Bitcoin and the rest of the shitcoins all look kind of trashy. So nothing really changed here though, obviously. You know, range bound. Whenever we're between the 200 exponential and 200 simple, you're like, oh, what are we going to do? I'm like, probably hit the 200 exponential. And then you're like, what about after that? I'm like, probably hit the 200 simple. And you're like, what about after that? I'm like, probably hit the 200 exponential. And you're like, well, what about after that? And I'll say, guess. Probably just going to bounce around like a little ping pong ball until we break in one direction. Range bound. Buy support, sell resistance. Avalanche. So underperformed that move, cooling down, getting ready to lose the 8, run out of steam, out of the bullish control zone. These alts look like they're fading. The rallies are getting faded. They're underperforming, all of them. None even made it to 382. Are they back testing in 236 before they go higher? I mean, are we putting in basically? I mean, the only problem, well, no, I'd say the only problem, but one of the many, many problems with these markets right now is that this is a really bearish pattern. When we have a leg in like this and then an ascending channel like this, the probability is that once we top out, now maybe we already did, maybe it's at the 382, but the probability is that we just get another leg to the downside afterwards. Now again, we can use our, you know, fib tool. We can use the measure move of the channel. We can use the length of the leading leg. We can put it in here like a moron like that, or we can put it in here the correct way like that. But I mean, that's typically what happens is you get a leg to the downside, you consolidate to the upside, and then you get a leg to the downside. As a matter of fact, here's kind of an example. Leg to the downside, consolidate back to the upside, and then leg to the downside. Now, I mean, it's not going to be science when we break down or whatever, but, you know, somewhere around here was our breakdown. It looks pretty similar. So something like that, essentially what it looks like to me. So tough to get bullish on these alts. They had all week last week and then into the weekend this week to do something. And now look at them underperforming, dot back at the entry, total trash right here. Basic attention token below the potential entry, total trash right here. I mean, these things are just giving up, rolling over. Chain link, back at the entry, just rolling over. Matic, still looking pretty solid, consolidating, much more bullish. Hard sell signal, a bunch of red histograms. Wouldn't give up on this one just yet. Looks like it wants to backtest the 382 though, so I mean that is like a 15% drop. BNB, decent little bounce, backtesting resistance. I mean, again though, I would be real careful on this thing. You know, it's like the same thing. We just have higher lows and higher highs, but you know, which is like, oh, that's good. We're just going higher. So the longer it just does this for, the higher we're at, right? Sure, until it breaks. You know, is it possible it breaks the upside? Sure, like 30% of the time it breaks the upside. 66 it breaks the downside. So we have a downtrend, consolidation to the upside. We typically break back into the downtrend. And where do we measure it from? The top? Nope, the bottom. Obviously. So that is it for the cryptos. Not looking too good. Don't mean to like gloss through them, but I mean nothing has like happened. They basically moved for like 4 days to the upside and then in one day just like wiped it all back out. Gold had a nice little move to the upside. We talked about that in advance, how we expected essentially a little bit of a bounce. Nothing crazy, not a tradable bounce, but a bounce nonetheless. Hard buy signal, multiple green histograms. Blue slope line from below. Got to be kind of careful with this. Reclaim the 8. Looks like we want to backtest the 21. 1750 seems likely. The most important thing, though, is that we did get down to that 1680 target. Obviously, 1675 to 1685 has been our target for some time. You don't have to be a genius to assume that we were just going to come back down and retest that same level once again, which, of course, we did. Silver, done nothing. Bounce right here. Had a nice little bounce, and then just consolidating at the lows. I mean, no strength whatsoever. Hard buy, multiple green histograms, blue slope line. I mean, this thing probably just continues to melt down. Clear bullish divergence between the low here and the low here. So does it want to burst to the upside? I checked premiums today for the first time in a while. And not because I was thinking about buying any gold or silver or anything like that. I was just curious, obviously. Obviously. Not like I'm trying to buy support on gold or anything and sell resistance or speculate. No, I'm not saying that. I'm just saying I looked at it. All right. And what was it? Gold was trading at about the cheapest coin you could get, basically. Generic proof, whatever, but notable name was like 50 over spot. Silver Eagle was like 200 over spot, which is roughly like 5 and 10% respectively. Maybe 5 and 13, which is about in line for gold. A little heavy on the Eagles. I looked at silver. Silver was $4 over spot for like any just generic coin. Was the cheapest one. $4 over spot. And silver's at 18 right now. 18.50. So that's almost a 25% premium. Not that long ago, I mean a couple years now, you know, with the pandemic and everything. Not long ago, silver was 18.50 and was trading at like 50 cents over spot. Or maybe it was 16.50, 17.50, whatever. But it was trading at like 50 cents over spot. So the spot premium right now is almost 10x on just your random silver. And then I looked at the Eagles, and you wouldn't even believe it. Unless you looked recently too. At one point in time, Eagles were trading at like $10 to $20 over spot when it was like shit was hitting the fan. They're trading right now, literally still, at like 13 to 15 over spot. And silver's trading at 18.50. They're trading at almost 100% premium for silver Eagles right now over spot. That is ridiculous. I mean, not to like say things with certainty because we never know what's going to happen in the markets. If you buy silver Eagles for $33 to $35 a piece, you will never make money on them ever. And you will literally never even be able to maintain your purchasing power over just buying generic silver, even at $4 over spot. I mean, that is insane. That is absolutely insane. Anyway, so yeah, $20 premiums, $13 premiums on silver Eagles. Get the fuck out of here. Get out of here. I mean, I think the Britannia is a nicer looking coin anyway. I mean, get a maple leaf, anything. There's no reason ever to pay that. All right, so continuing on, gold-silver ratio, retesting the highs from back here in 2019 before the massive breakout all-time high. There's nothing left to stop us. Gold Daddy says, hey, if we break through this right here, if we rip through this, again, you know, there's some downside candles, obviously. But when we broke through this last time, now granted it was a blue sky breakout, but it took us 3 weeks, and we went from 92 silvers to 1 gold, all the way up to the blow off top of 128 silvers to 1 gold. So if you were holding silver right here at this peak, relative to gold, you lost 38% of your buying power. If you were holding gold, relative to silver, you gained 37% buying power. So we're about to, and again, we don't have to. We could get rejected here and go lower, but we're about to take out that high. And again, 3 weeks, it took us to go up, 30+%. Confirming back into a bull trend on a weekly time frame. Gold to silver ratio. I mean, if we break through this area and even just consolidate a bit, it's likely we retest the all-time highs. I mean, maybe we put in a lower high, come back up to 786, roll over, and maybe we only get back up to 110. Maybe we come to 618 and we get up to 97. I don't know. We'll see. I don't know where it's going to top out. Maybe we put in a new all-time high. But the fact of the matter is, this chart is extremely, extremely bullish right now. And there's very little stopping gold from just tearing silver's head off. And yeah, I don't want to be on the wrong side of that one. I mean, if you're not selling any gold or silver, it doesn't matter anyway. If you're planning on buying, it matters to you, obviously. So pot stocks. So we did exactly what we said. In the last couple hours of the trading session on Friday, we broke down and lost 821 cross. No surprise. We talked about how every one of these has failed, and we're headed down to new all-time lows. Makes sense. Tons of bullish divergence, tons of momentum. It fails every time, continues to fail, continues to put in new lows, as expected. But again, you guys know I'm extremely bullish on pot stocks with diversification. Because I'm going to tell you right now, if we pick 5 pot stocks, one of them probably goes to 0. But the other 4 probably like between 10 and 50x. So I'm, pricing that in accordingly. Tilray, again, same thing. I had a pathetic bounce right here. Typically get a nice little trade set up. Plays out real nicely. We didn't have a good trade set up on this, and I didn't want to get too bullish on this, but this thing just rolled right over. Again, very close to confirming back to downside. New lows coming. CGC, I told you guys I picked up a small position in CGC. It's like a set it and forget it type thing. If we were to get some little 50 or 80% move to the upside, I would take profits on some of it. But essentially, I'm ready for this to just go to 0. But again, it's just little itty bitty little munches. And the only reason I'm doing it is because I didn't, we were responsible and didn't dollar cost average into this downtrend the whole time. So now once we're down, once this asset that I believe doesn't go to 0, but maybe still does go to 0, once it's gone down 95.7%, you're like, well, I thought you didn't dollar cost average into downtrends. I'm like, you're right. And we probably do go lower. We definitely could go lower. But there's people right now that are down 95.71%. And we're just getting in at break even right here. Doesn't seem like a bad deal. Doesn't seem like a bad deal. I mean, we 10x back to the upside, 20x. Or maybe it just goes to 0. So we got the move back up on those uranium stocks, back testing the 200 exponential and simple. Nothing really changing here. You guys know my macro on uranium. Very, very bullish long term, but do expect further downside. You know my macro on commodities in general, on energy in general. Very, very bullish long term, but potential for further downside. GSG, the commodity index, bounced the 200 exponential, got the push back up, got rejected, like slightly below the 21, slightly below the 382, lost the 236 as support. So are we coming back down here to retest that bottom, look for a double bottom at the 200 simple? That seems likely. Hard buy coming out of bearish control zone, bunch of green histograms. The fact that we lost this tells me we're probably coming back down. If we do come back down here, retest the lows, maybe we have a left shoulder, head, right shoulder, head and shoulders. The breakout takes us back up to the 618, somewhere around like 24 or so. Nice little 15% move. Seems likely. There's going to be an opportunity here real soon, but not quite yet. Same with copper. Definitely going to be some opportunity here in the near future. Just not right at this second. We did hit the 786 pretty nicely. Oh, no, I'm sorry. I mean, we did, but that's not what we're looking at because that was the previous fib from the high to low in orange. We hit the 0.5 pretty nicely, which was the low to high in white right here. Let me actually switch the color on that to green. There we go. From green right here. Bounce at 0.5 pretty clean. Back testing resistance. I mean, not yet, but you would think we would. It seems like we would bounce back up to the 382. We bounced to 236, lower high. Shot through the 382, all the way to the 0.5. Maybe back test the 0.5, then go down to the 618. We'll see here. We'll see. If it would have held this area, it would look a lot better. Obviously, Dr. Copper could be that canary in the coal mine for commodities or just global growth in general. Yeah, I'm not going to do all the coppers. JJC on the daily, a little more technical. Again, very nice bounce off the 0.5. Seems likely we'll get a back test of the 382. Very, very beat down. No bearish divergence or anything. Not showing like clear signs of exhaustion. Maybe a little bearish divergence on the stochastics. Yeah, pretty bearish price action though. Southern Copper, same thing. Back testing the 382 off the 0.5. FCX. Back testing the 236. Didn't even make it to the 382. So obviously this is the strongest. So you could argue that this one's going to hold up best. I mean, because it didn't go down as much, there's not as much upside potential back to the recent high. But if we see further downside, and you're a little early, at least you're not going to get waxed. We'll see. I think it's time to watch, but not quite time to enter. And we see COPX somewhere in between. Bouncing the 382 pretty clean here. Still well off the 236, but shallower retracement on a couple of these. CRISPR Therapeutics. Okay, so we got that back test like we discussed. Came all the way back up to the 382, back to the 0.5 in green here. Topped perfectly at the 0.5, lost the 382 almost right afterwards, and now we're back testing the 200 exponential, potentially 200 simple. So this looks like our China charts. We're in a clear bear trend. We get way far undervalued. Reversion to the mean. Back test. Back test. Try to flip bullish. If we hold here, these both flip blue, and we get bullish. If it fails to hold, flips back down, it looks like just a failed breakout or rejection or throw over, something along those lines, and then we just continue the bear trend. So the most important thing to pay attention to right now is, are we going to consistently put in higher highs and higher lows, or are we going to break back down, start taking out our recent swing lows, and stop putting in swing highs, aka start putting in, more lows, something along those lines. It's not really much on the top to go by. So maybe we'll see. Maybe it bursts up here to the top in the near future. But if it breaks down below the 200 exponential, the 200 simple, and the ascending channel, we know obviously that we would expect more downside. And if we start taking out the recent swings, we expect more downside. But as long as we're above the 200 exponential and simple, we have to start getting like semi-neutral on this for it to hold. Now I'm still bearish, but we consolidate up here for a little bit, start chopping around. It's going to start looking pretty good, especially if you take out this recent high as well. The indicators look pretty tired though. It looks like it's ready to roll over, bearish. DRV, Drexion Daily Real Estate Bear 3X. So back down at the entry again on this one. I mean, I wouldn't be hanging tight. When we lost that 200 simple, 200 exponential rather, that's a no-go for me. If we come down here to 200 simple, we could still bounce it and technically not take out that low. If we break down below here, obviously that's why we have the stop loss down here. If we break down below that point, now I'm not in this trade, obviously, but if we lost that support right there, you want to be out, and that's why it stops there, because we're taking out the recent swing, in which case we're likely coming down to this all-time low. And probably just going to go much, much lower in time, because that's essentially what you would expect from these. So that's what we're paying attention to. Again, though, this is the entry. It went slightly in our favor for a little bit, and then back tested. I can't even remember. But I wouldn't want to take a loss on this. You had a bunch of time for it to play out, and it hasn't played out. You just, in my opinion, on to the next. Now, it could just burst to the upside tomorrow, and you're like, oh, 140%, fuck. That's trading. That's up to you. You got to make your own decisions. None of this financial advice, obviously. Or tax advice. Or just life advice in general. Occasionally, some of that. UTZ, UTS. Same thing, long-time bear trend. Starting to confirm back into a bull trend. 200 exponential, flipping bullish. 200 simple, flipping bullish. Had a little bit of a pullback off that last one. But, I mean, this is pretty bullish. Got to be careful. Sell by sell potentially here in the near future. I mean, this looks bullish, obviously. The longer we spend above these, the longer we consolidate, the more bullish it looks. What I would be looking for, basically, when we break above the 200 exponential and simple, I'm looking for a back test, and then the back test to hold as support. And then once it holds, I mean, that's just, hey, look, it's the beginning of this. That's it. It's the beginning of a bull trend. The same way this is the beginning of the bear trend, we're looking at potential beginning of the bull trend. And if we're right, there's trade setups here in play for potentially, lower high target 23%, 47%, and 100 million%. 239%. I was off slightly. 239%. 1.618. Fibonacci extension. Do it. Nice risk reward ratio though. 3.3 to 1, 6.5 to 1, and 33.59 to 1. Wayfair. W. Looks like it's about to take the L. Crossing back down. 821. Looking weak here. Very pathetic. New lows. I mean, hey, guys, look, let's be real. We talked about this. There's no reason for us to assume that we're going to consolidate above the 618. There's no reason to assume we're going to get a pushback up to the upside. More likely than not, if we don't get above the 618, more likely than not, I mean, realistically, the trade's to the downside. I mean, this thing's melting down. It looks disgusting. Now, does it have to have a capitulation bottom like this where it just melts down straight to zero? No, but I would be real careful. Man, that looks so brutal. Maybe it bottoms though. We'll see. But I mean, let's be real. If this thing takes out 44, just don't look back. Don't look back. CSGP CoStar Group Inc. Again, just putting in consistently higher lows. Consolidating. Still bearish, obviously. But seems like there's some potential. Again, we talked about in the last stream, I would try to get a buy off of the 236. Might have already missed your chance on this one. Also, more likely than not, if you do get a push up, it's probably a back test of the 200 exponential or simple, and you only make it to a 0.5 and then it underperforms. So there's really not even a risk reward trade setup here, unless this like overperforms to the upside. So to tell you the truth, there's probably way better assets out there, trades out there, whatever. So I don't know what I said last time, but this just, I don't even want to look at this. I don't even want this on my chart. So yeah, that's it. We made it to the end. We made it through the assets. Yeah, we looked at all kinds of shit, man. There was so many good charts. How many good charts did we see total? 3. Well, that's a good. Out of how many though? 5. Well, that's like 60%. Oh no, wait. That was like 50. So 3 out of 50. I don't like those odds. KO says, not a good risk reward on aliens. Yeah, I do not like my probability of success on that one. It's either way higher than we think or way lower. Or actually, it's probably either way higher or just like exactly what I think. Which is either 0 or, oh shit, we were wrong and there's definitely aliens. Like statistically speaking though, with how big the universe is or like galaxy or whatever metric of measurement of space you want to use, the probability of there not being other forms of life. Now, are they intelligent life? Are we intelligent life? I don't know. You could argue either way. I mean, I would say yes, but like on a scale, I don't know. I think when we picture aliens, we picture them being either like plankton or like super advanced. What if we just find like just more of us and we're like, oh, fuck. They're just like us. We're fucked. Calma Betty says, Bitcoin, next wave down. It's coming. Yeah, I mean, look, we have had all the opportunity in the world for bullish moves. And you're like, we just went up 50%. Is that not enough for you? And I'm like, yeah, I get it. And it's nice to lock in those gains, but there was so much more potential for this recent bounce that was like unrealized. And I just feel like it's like just these two little grains of sand kind of bumping up against each other before they fall out the hole. Maybe I'll be wrong though. Maybe the markets just flip bullish after this. And maybe the Fed just pivots and all of a sudden they're like, you know what? We're pretty sure that inflation thing's going to go away. And they bring back transitory. They're like, matter of fact, we're bringing back a term that we haven't used in months. Matter of fact, transitory is in again. Inflation's transitory. Maybe. It's possible. But I don't know. I just don't see it. It's hard for me to look at everything going on right now and build a case for why the stock market, crypto, or bond market is going to be higher 3 months from now. Now, 6 months from now, a year from now, 2 years from now, 5 years from now, 10 years from now, 20 years from now, I'll build you a case on any of those other time frames. But 3 months, 6 months, it's tough. It's really tough. Do I think the stock market will be higher than where it is right now in 1 year? Much better probability than in 3 months, in my opinion. Obviously, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. Bitcoin 9K soon. Excuse me. Elon knows. I think 14K is probably pretty likely here. And people are like, it'll never go to 14. I'm like, it's just at like 17. 14 is like not even that much further. And then you're like, well, if it goes to 14, it might go to 12 and a half. And if we see it at 12.5, 10's only a couple thousand away. And if we break through 10, it probably goes to 8. And if we see it at 8, it's, I mean, 6 isn't that far off. And then 5,500 is right around the corner. So we retest 3. And then if we break 3, probably 1,800. If we go lower than 1,800, I think probably like 1,000 or maybe 800 is the lowest it goes. If we break through that, I mean, it goes straight to 0, I would imagine. So, but I mean, you could say the same thing to the upside. It's like, oh, if it goes to 70, it goes to 80 this time. And if it goes to 80, it's already to 100. And by the time it goes to 100, overshoots 110. I mean, so we don't really know where the pivots are going to be. We can build a case for support, resistance, fib retracements, extensions, etc. But it's really just levels. It's all about that slinky theory. But yeah, I think we're wrapping up there. Nice stream, everyone. 2 hours and 25 minutes. So we crushed it. We made it in like 35 minutes under the 3-hour mark. So that's always good. And by always, I mean this is like the second time it's ever happened. So that's good. But yeah, make sure to check out our stream on Wednesday, every Sunday, every Wednesday, 8 p.m. till 10 p.m. or more. Every single Friday, we do it in the morning to afternoon, 11 a.m. Eastern Standard Time. On Fridays, brought to you by the members. Thank you, all members, all new members as well. If you are interested in any of the indicators, you can get them all for free down in the description, with the exception of the most recent iteration of the Jewel Thief and the Master. Those are group member exclusives. If you're interested in the group, if you're interested in the indicators that are exclusives, you can reach out to me via email. But that being said, going to wrap it up there. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. It is 10:30 p.m. Eastern Standard Time on 7/24/2022. I am, of course, Crypto Trend Trader. These are, of course, the charts, the technicals, and some opinions / fundamentals as well. Big week right now. Big week. If we see moves on that VIX, if we see bullish moves on the VIX, bullish moves on the dollar, bullish moves on the funds, either the 210 or just Fed funds rate in general, whatever. It's going to put a lot of pressure on everything, the same way we have been seeing it. So we know the two strongest charts are the DXY and the TNX. Some of the only bullish charts that we have. Energy is still fairly bullish. But retesting the 200 exponential and simple in many cases. So that being said, if they continue bullish, we should expect more of what we've been seeing, which is everything else pretty much selling off. If one of them reverses to the downside, let's say the DXY, that tells us probably that the rest of the basket of currencies is increasing in value. Therefore, probably the Fed is flipping or turning, or the ECB and other relative central banks are becoming more hawkish than the Fed in relation, and then vice versa for the for the Treasury. If we see like the 210 coming down, correcting deeper, going lower than the Fed funds rate potentially, we know that the market is pricing in, easing, inflation ending, Fed funds rate coming down, 210 yields coming down, bonds going up, in which case we could see some strength in the markets. So we'll see, but until something changes, until we see a Fed slowing, then stopping of rate hikes, then pivot to easy money again, there's no reason to think the markets are going to turn around, or that we put in the lows, or that we're going back to a bull trend. And in order for that to happen, we know first one of two things needs to happen, and one of them has big priority, and that priority is inflation needs to come down. We need proof, numbers for month after month to prove to the Fed that inflation is coming down consistently. And we know that in order, the other option is we see massive, just ridiculous unemployment and job losses, just ridiculous, to the point where the Fed has to say, oh, we can no longer just prioritize inflation. We need to look at inflation and, employment again. But until we have a pivot on employment, which is nowhere in sight because we're at record lows, and until we have a pivot on inflation, which is nowhere in sight because we're at 40-year highs, I don't see any Fed pivot. Therefore, I don't see any of those situations playing out. Therefore, I don't see any of these asset classes having bottomed or any of the narrative switching. Therefore, I expect the dollar and yields to continue strengthening to the upside. and that putting extreme pressure. And likely, if we see that pressure pick back up again, we'd likely have just had a bearish reset in all of these equities and cryptos, and we're about to get another big leg to the downside, probably through key support levels and to another key Fibonacci level, which puts us at our targets for Bitcoin, for the major indexes, and zero for a lot of like speculative trash cryptos and stocks as well. Obviously, none of them are going to zero. I'm just exaggerating. But that's it for today. So everybody have a great week. I will see you group members in the group as usual. Definitely had me a little day and some change off there over the weekend as I participated in real world, which was fun. Not as fun as it could have been, though. There was definitely some little bit of a disappointment on the entertainment factor. But I won't bore you guys with that. Many of you probably know what I'm talking about. But yeah, we'll wrap it up there. Everybody have a great week. See you all in the group. See you all on Wednesday. Digital Darewood says, you the man. No, you are the man. Thank you for participating. Thanks for the comment. Coleman Betty, good to see you. Great show as usual. Thanks. Of course, brother. Everybody have a wonderful evening. And that's it for tonight. See you guys on Wednesday. Crypto Trend Trader. And I'm out of here.